Alrighty, folks, this is a session that I personally have been looking forward to for about 6 weeks. It's actually something I dreamed of about 6 months ago, where we would take the expertise of Mr. Dan Bird, who comes to us every Sunday and has been right for most of this cycle, which has been amazing. He's going to show us what he does for technical analysis. He's going to also show us his risk calculator, his tools, and then finally, we're looking forward to having an hour to review stocks that are important to you. You have 2 chances to interact with him. 1, you can ask questions, which I will be moderating. And 2, you will get a chance to ask about stocks. This will be a 3-hour session. This will end at 11 a.m. Pacific, as I will need to head out right to the airport. So Dan, the floor is yours. I will be moderating what's going on, and enjoy the show.
Great. Thanks, Mike. Thanks for putting this together, and thanks everyone for joining. Really appreciate it. I'm hoping that this will be a class kind of an educational session. I'm going to go through fundamentals and technicals, technical 101, essentially. It's kind of like how you and I first started talking, Mike, when we talked about learning technicals, learning how to read charts. It's like learning French, right? So you start learning by translating from French to English. Eventually, as you immerse yourself, you just recognize the French. You don't translate any longer. You just recognize what it means. Now, some of the folks on the call may already be fluent, and others may not know much more than bonjour and oui, oui, right? So the Technicals 101 is to try to get everybody on the same page, up to speed, and lay a foundation. And then I'm going to go through a real-time analysis of Netflix using what we've learned. And then I'll talk about risk management, the risk calculator, and I'll actually show you what that looks like. And one of the folks on the channel was kind enough to send me a really nice testimonial. And he also sent me some slides of his portfolio that he's increased by 30%. And he's going to actually talk about that using the risk calculator. And then I'll quickly show some of the platforms I use: stock charts, VectorVest, earnings beats, etc. I'm not going to spend a lot of time in those, but at least give you a sense for what they do. But most importantly, how I use those to put together a list of strong fundamental companies that I can start with. And then we'll open it up to questions. Special announcement, I think people already know that I've started a website, so I'm just going to step through that real quickly, give you guys a chance to see what that's all about. It's how I'm going to deliver the newsletter from now on, because it's just becoming unwieldy to do it through email. I basically can't do it anymore through email. I'm getting to the point where I might get flagged by my email provider as a spammer, as many as I'm sending out. So I had to figure out a different way to do it. So anyway, that's the agenda. Let's get started. Start with technical analysis 101. Technical analysis essentially is the visual representation of market psychology. And a lot of people that haven't studied it or don't understand it think that it's just a bunch of lines and pictures on a chart, and somehow magically it's supposed to tell you what's going to happen. That's not quite what it is. Marty Schwartz is a trader that's been on Wall Street for quite a while. He said, I always laugh at people who say, I've never met a rich technician. Such an arrogant, nonsensical response. I used fundamentals for 9 years and got rich as a technician. So that there's a lot of good Wall Street folks out there. Most of the big firms actually use technical analysis. But it's not a crystal ball. It's not going to predict what's going to happen. It's a windsock to help you understand what the trends look like. So it helps you understand what the crowd is thinking. And that I think is the biggest one. That's why I said it's a visual representation of market psychology. It helps you understand what the crowd is thinking. Or another way to look at it, it's sort of like, where's Waldo? But in this case, with technical analysis, it helps you understand where's the orders. Where are the orders located? Where are the big traders looking to place their orders to either buy or sell? So there's 2 major schools, fundamental versus technical analysis. Investors and traders use both to research and forecast future stock prices, and both have advocates and adversaries. Fundamental analysis is identifying the intrinsic value of a company using earnings, expenses, assets, liabilities, etc. Whereas with technical analysis, the concept is all known fundamentals are already factored into the price. So the price and the volume essentially represents what the fundamental value of that company is already. And only when there's something out of whack between the fundamentals, that technical analysis will help you understand when something is going differently than what you might have expected. So this is a really good example of how the stock market and the economy differ. So the blue line is the economy and the red line is the stock market. And you can see how the economy actually trails or lags the stock market. Or think of the stock market as the technical part of it and the economy as the fundamentals. So when you hear folks talk about the economy, when they talk about recessions, when they talk about price to earnings ratios, when they talk about inflation, things like that, keep in mind that that is lagging the stock market for the most part. Stock market usually is 6 to 9 months ahead of the economy. So if we look at December 2021, the market hit a high. This is the S&P, hit a high of 48.18. That's, Mike, right about the time you and I started doing the YouTube sessions.
Correct.
And I pointed out on the charts at the time that they were indicating that there was rotation out of growth and into value stocks, even though the market was hitting new highs. So the technicals was telling us ahead of time that the market was ready to go down. But if you look at the blue one over here, the blue at the same time was way down here. First rate hike was in May of 2022. You can see that the market had already anticipated rate hikes coming. So the market had already started dropping way ahead of the rate hikes. But the economy was still hitting the peak. Jackson Hole, more pain ahead. So Powell came out and said more pain ahead, June 2022. He hit the first low right there. October 22, when it hit the final low, 34.91, that was the low of the stock market. The economy didn't, and they were talking about recession, but we may not have a recession, or it might be a very light one, was much farther ahead. May 2023, that's when the economy started to pick up slowly. And right now we're right here. We're 3/4 of the way back from the bottom for the market. So always keep this in mind when you hear folks on CNBC talking about what the economy is doing. Remember, the stock market is already pricing that in. It's already expecting that. So you have to be aware of that. This is another good example. So a lot of times you hear, don't fight the Fed. When the Fed is raising rates, then the stock market is going to drop. And historically, that's true in the very beginning of rate hikes. And if you go all the way back to when rate hikes first started, that's true in the very beginning. And if you look at this right here, the first 5 rate hikes, the market was heading down. But the next 5 rate hikes, the market hit the bottom right there and kept on going up. And we are still climbing. We're 3/4 of the way back now. Incidentally, look at that bottom. Look at that candle right there on that bottom, or that bar. Notice how it went down and came right back up. In one day, the market hit bottom and bounced all the way back up. That's what I mean by where are the orders? You have to try to understand where the orders are. So all of the big traders on Wall Street were expecting a bottom. 7 out of 14 bottoms have happened in October. And they were placing their buy orders right down there, hoping the market was going to get down to around 3,500. And you and I Mike talked about 3,500 for quite a while. That's where the market looked like it was heading. Well, that's where all the big traders had their buy orders. That's where the orders were. So as soon as it hit there, it took off, and it hasn't looked back since then. So that's another example of how the market is 6 to 9 months ahead. So the best approach then is combining the two of these, combining fundamental analysis with technical analysis, so that you have a list of the best fundamentally strong stocks, and then you apply technical analysis to it. So technical analysis then can give you a historical view of what's going on. The charts can show you optimal entry and exit points. So it helps you understand where to enter rather than just buying at any price. But we start with the fundamentals. We start with strong companies because you want to determine the all-important intrinsic value. You want to have a list of strong companies to start with, but don't buy at just any old price. what you actually pay for a company's shares is the most important determinant in your future returns. So the buy point is the important part. Technical analysis can help you time your trading decisions. So it'll help you see accumulation or distribution, whether the big traders are accumulating or distributing a stock, whether a stock is gaining or losing momentum. And if it's losing momentum, that's not the time you want to be buying. So here's a quote. I have a few quotes from major traders in here. Make your money on the buy, not the sell. And this is true in any investment, whether it's real estate, business, or the stock market. Your money is made at the time that you buy, not the time that you sell. I want to talk briefly, and I've talked about this a lot before, about secular markets. Secular market is driven by forces that cause the price of an asset to rise or fall over a long period. That's what secular means. Secular bear markets exhibit selling pressure over an extended period. Cyclical markets, on the other hand, are shorter in duration. So you can actually have a secular bull market, but have corrections inside of that, or bear market cyclical periods inside of that longer term bull market. Same is true for a secular bear market, just the opposite. And here's the best example of that. Now, this is a chart that I borrowed from Tom Bowley. For anyone out there that follows Tom, you can find him on stock charts. I love the way that he does analysis. He looks at things a little differently than a lot of others do, because he looks at inter-market relationships. How are things related to each other? And this is a good example of secular bull and bear markets. So first, you can see the secular bear market that started in 1929 with the market crash. This one did not break out of that high from 1929 until 1954. That was a 25-year bear market. Even though the low was in 1932. So if you were lucky enough to buy in 1932 and hold on, you could have ridden this all the way out. But the actual bear market did not officially end until this previous high was broken. And that was in 1954. Then we had a secular bull market, which ended in 1969. And then the market went sideways for 12 years. So secular bears typically last 12 years. And then it broke out again in 1981. And we had a historic secular bull market for 20 years, 1981 to 2001. The market just went up. And 1987 was a huge crash. Market went down something like 30% in one day. That's this little blip right here. So in the context of a long-term secular bull market, even that huge crash in 1987 is just a little blip. This is the secular bear market that started in 2001, but did not exceed the high until 2013. Even though the actual low was in 2009, it didn't break out above the high until 2013, and we are now currently in another secular bull market. By the way, we're going to send these slides to everyone afterwards, so you guys don't have to worry about trying to capture screen captures and things like that, unless you want to. You're certainly welcome to. The COVID crash, you can see it right here. COVID crash was another huge crash that went down very rapidly. But again, in the context of this long-term trend, it's just a little blip. Now, if we zoom into where we are right now, this is the 33-year view of the previous secular bull, the secular bear from 2001 to 2013, and the current secular bull market that we are in. And this is the chart that I use to determine whether or not we are still in a secular bull. And I've had people ask me, when will you decide that we're no longer in a bull? Well, when one of these indicators turns red, that's when I will start to raise my antennas and determine whether the secular bull will continue or not. You can see even in 2022, when we had that big cyclical bear market, it still did not break the 200-week moving average. It did not break down below zero on this momentum indicator, PPO, and it never went below 40 on the RSI. So throughout the whole term of the secular bull market, we have still not reversed. So we are still in a secular bull market. Remember, they run 18 to 20 years. So we've got probably until 2029 to 2031, somewhere in that range, for this bull market to continue. The high right here in December of 2021. We're headed back to it. We're already 3/4 of the way back, and we probably will break through and head higher even from there because of the secular bull market. Now, interestingly, 2029 is the 100-year anniversary of the 1929 market crash. So wouldn't it be coincidental that that becomes the period where this whole thing falls apart? We'll see. We don't know yet. And this is a little closer view. This is a weekly chart that shows the current cyclical bear market. You can see here, this is the pink lines are the range from the high in December of 21 to the low in October of 22. And this pink one up here is 25% left. So we are right at 75% recovery from this low. And sometimes when I tell people that, they're surprised because they still feel like the market is ready to roll over and continue to go down. And they don't realize that we're already 75% of the way back. So I think we're actually going to get back to the high by the end of this year. 14 of the last bear markets have ended in October. 7 of the last 14 have ended in October. So this is a clue, once again, that we continue higher. So that's the big picture. So you want to start from the big picture and then go down. Big picture, sector, industry, stock. And that's what I'll show here. This is something that comes from stock charts. It allows you to do a sector rotation so you can see what the sectors are doing and how they're rotating. This one I ran on Friday, and you can see here that industrials actually are starting to perk up, starting to come back. Energy too is starting to come back. So I circled industrials, so that's where we start. We start with the best sector. Within industrials, then we look at what industry groups are doing the best within that particular sector. And we see building and materials is number 3 on the list. So if we take a look at the stocks inside of building and materials, there's one right here called Technoglass, which is a stock inside of this. So good sectors, good industries, good stocks within all of these. Let's take a look at this particular one and see what it looks like. So there's the chart on Technoglass. By the way, that is the process that I went through. And I ran a scan, which I'll talk about later. I ran a scan that helps me identify reversal patterns. So stocks that have been going down consistently for more than 4 days and have suddenly reversed and started to go up. And my scan showed me this particular one right down here. I bought it the next day, right here, and stayed in it all the way up until right in here. Now it's actually gone a little higher than that, but that's fine. I'm satisfied with, I think it was about a 20% gain in about a month. So that's the way that you should think about it. That's the way to take a look at what stocks are doing and help you understand where you should go. Let's see. There we go. All right, so price and volume is the first thing to look at for technical analysis. And that's really the key. That's the basis, the foundation of everything. Even the big traders on Wall Street, when they use technical analysis, they're primarily just using price and volume. They're identifying resistance and support levels. So in a healthy bull trend, prices make a higher high and a higher low. That is the key thing to understand that we're in a bull market. What happens during the rally? First, the buying of the stock by those who are covering their short sales. So to cover shorts, because the market's going higher, they have to buy after knowing that they're in the wrong direction. Second, actual new buying by those who expect the advance to continue. Now, what happens after the rally? If the rally is due to more short covers than long buyers, then it is likely to decline. So this is typically what happens in a bear market rally. When the market rallies, but then it turns around and goes back down and makes another lower low. The shorts have already covered, but new long buyers have not come in. If the rally is due to actual new buying, the trend is likely to continue. And then the same thing on the bear side. Prices make lower highs and lower lows. So it's important to understand what the market is doing, understanding the trend. If price is rising and volume is rising, you're in a strong uptrend. Price is rising and volume is declining, you're in a weak uptrend. price is declining and volume is rising, then you're in a strong downtrend, and price is declining and volume is declining, then you're in a weakening downtrend and maybe ready to reverse. So support is essentially when prices fall because there is an excess of supply over demand. So as the prices come down, at some point, the lower prices go, more attractive prices become to those waiting on the sidelines to buy. So once it gets to a point where the people on the sidelines say, it looks like it has value now, I'm going to start buying. Remember what I said in the beginning. Try to figure out where the orders are. Where are the orders? Now, you don't know until this bounces and starts to go back up. And you don't know if that's support until it comes back down and bounces again. So to identify support, you need at least 2 of these to draw the line. But you can see that once that's been drawn, next time it came down, it bounced up. Next time it came down, it bounced up. So this is where the orders are. This is where all of the sell orders are. So people that get in on the long side, if they know that this is support, they put their stop losses just below that to sell if it breaks through. But this is also where the buy orders may be. So if a lot of buy orders start to build up with folks that see that 4 times this has happened, and now they're ready to get in because they think it's a pretty substantial support level, then the buy orders may be a little bit below this. This is why sometimes you see a stock will break through the support level just barely, take out everybody's stops down here. And I've heard people say how frustrating it is. It's like, are the market makers seeing where my stops are? Do they know that I'm down here? Well, they don't see your particular stop, but they know where the orders are because this is where the support level is. So they know everybody else is putting their stops down here. So they push it down to take those stops out to be able to have the supply to fulfill all of this demand as the stock goes back up again. This is what happens at resistance. Same thing, but reversed. This is a good example of explaining the psychology of technical analysis, because this is one that really makes a lot of sense to a lot of folks. So all the people that bought on this big green candle right up here, everybody that bought right up there, and all of a sudden it reversed and started going down, they're saying, oh my God, was I wrong? I don't want to be wrong. I want to be right. Now my stock's going down. It keeps going and going. And they're like, well, it might be too late to sell now. So they hang on. And then as it starts to come back up again, they say to themselves, please just let it get back so I can break even. That's all I want. Just let me break even. So when the stock gets back up here to break even, all the people that bought over here are selling over here. And that's what pushes it down again. And then the same thing with an uptrend. Stocks can also create resistance or support with an uptrend line. And what happens here is this is a strong bullish trend because the stock comes down and some people might want to wait till it gets down here. But if it's a strong stock, they don't wait. They buy just before it gets to the bottom. And then when it comes down again, they don't wait for it to get down here. They buy just before that. And then that creates another trend line just like that. So that's the basis, support and resistance. Short-term volatility is greatest at turning points, and then it diminishes as the trend becomes established. So for those folks that like to do options, for instance, you'll find that at turning points, that's where you'll find the most volatility. And then as a trend gets established, the volatility falls off. Very quickly, an intro to candlesticks, and then I want to show a real live trading idea using Netflix. So markets are strongly influenced by the emotions of traders. Candlestick charts can show the emotion by visually representing the size of price moves with different colors. They're used by traders to determine possible price movement based on past patterns. They have an open, close, high, and low. And a lot of algorithms are based on what these candlesticks look like. So this is basically what it looks like. The open one or the white one or green sometimes is a bullish. So it opens down here, it closes up here, but you can see it traded all the way down and all the way up. That's the shadow or the wick of the candle. A closed candle or a black one or a red one means that it opened up here and closed down here. So it closed lower than it opened. And each of these can tell a story. Again, this is the psychology of what these are. This is, again, learning French. At first, you try to interpret what they mean. eventually you just automatically understand what they're telling you. So a long white candle indicates that the bulls were in control of the ball for most of the game. A long black candle shows you that the bears were in control. So the bears opened up here and it closed down here. So they were selling for most of the day. Small candles show that neither the bulls or the bears really controlled it much, and it kind of ended close to where it started. Ones with long wicks or long shadows like that, these are the ones that I love to see because it really tells you the psychology of what's going on. A long shadow for the bull up here means that it opened here. The bear stepped in and tried to push it down. So there was lots of selling all the way down during the day. And then the bulls came back. And by the end of the day, the bulls pushed it not only back to where the open was, but even higher than the open. So that was a big win for the bulls. This is also a bullish candle, even though it's black, because in this case, it opened up here. The bears tried to sell it off and push it all the way to the bottom, but it came all the way back and didn't quite close at or above the open, but it closed pretty close to it. So this shows you that the bulls are in control. Same thing on the opposite. In this case, it shows you that the bulls are trying to push it higher, but the bear stepped in and people started selling. This is the candlestick that for those watching the market on Friday, and especially watching semiconductor stocks, if anybody was watching NVIDIA or AMD or any of those, this is the candle that you saw. You saw a huge run up in the morning, and then throughout the rest of the day, all the way into the close, they just sold off all the way down. Those are ones that I don't like to see if I'm long, because that implies that all the bears are now stepping in and people are selling. And then finally, this is one that is basically indecision. So neither the bulls or the bears won. It went up, it went down, and ended right in the middle, right near the open. And that means it's indecision. It could mean that the trend will continue higher, but the bears are testing it to see if it could shoot it down again. Or it could mean that it's a reversal. So if you see something like this at the end of a very long upswing, then that indecision means that the bears are stepping back in, and then the next one may push it down. So think about that. You can also look at these rather than open and close. It's just a bar chart. Open, high, low, close. Same idea. The open is on the left side, the close is on the right side. Same idea, but it just doesn't have an open body. And then finally, one that I really like, and I'm going to actually show this here in a second, is Alexander Elder created something that will combine both trend, which is up here, anything that is above the 13-day moving average, helps you understand what the trend looks like, and it combines momentum with the MACD. So MACD can help you understand the momentum of the stock. And what it does is, if it's above the 13-day moving average, if it closes above it and momentum is moving up, it's green. If one of those is different, if the momentum is going down but it's still above the 13, it turns blue. And then if it goes below the 13 and momentum is going down, it turns red. So the idea here is we do not short on a green one. You can buy on a green one, but it's best to buy it right after the trend change, right after the red one, if you got a big green one. If it's red, you do not buy on a red. And if it's right after a green, then it might be a good time to short. If it's blue, you don't do anything. Either way, don't do anything. So I like this because it combines the two of those things together. Chart patterns. I'm not going to spend much time on this. You guys will get the slides. Chart patterns are different patterns that you can recognize. This, again, is learning French after you get used to it, and you can recognize these immediately. You can understand what they mean and what they're telling you. These are patterns that typically are used for setups. You hear folks that say, I'm looking for a particular setup. A lot of times they're looking for patterns like this, and they, again, recognize those patterns right away. So over time, you'll start to recognize them as well, but it's good to review these and just see what those patterns look like. All right, finally, Fibonacci numbers. Fibonacci, I've talked about this before. A lot of people, I mean, this is really where it seems like it's magic. But Fibonacci is, these are numbers that basically is a sequence starting with 0 and 1, and then you add the next number to the previous number to get the next one. And interestingly, it creates a pattern discovered by Italian mathematician Leonardo Pica, which is his basically went by Fibonacci, in 1202. It's called the golden ratio or nature's code because you can spot them in everything. They're in nature, they're in math. You can see them here in the tree, how the tree limbs grow, in plants, in shells, in galaxies, even in hurricane swirls, even in the dimensions of a face or the Mona Lisa, for instance. Here's the girl with the pearl earring. All of these have Fibonacci sequences as part of them. So how do we use them in trading? So if you look at these numbers, this is the sequence. 0 plus 1 is 1, 1 plus 1 is 2, 2 plus 1 is 3, etc., all the way through. You add the next number to the previous one to get the next number. And that's what creates this pattern. The ones that are larger here are the ones that I use primarily. And I color code them. You'll see that in my charts, 8, 21, 50, and 200. Those are the colors that I use. That way, no matter what chart I'm looking at or what time frame I'm looking at, I already know what those moving averages are. And then less common, I'll use 5, 13, and 34, and 89. But you'll see in my charts, these are the ones primarily that I use. All right, so let's look at a real-time view using Netflix. Let's take all of that foundational information that I've just put together and actually try to do this. So here's Netflix. This is the time frame here is 2022. Remember what was happening? The market was going down. This is April. Netflix reported earnings right here. The stock was already going down. So let's step this through one day at a time. So the next day it was going down. The next day Netflix went up. And this happened just before earnings. So folks were expecting good earnings, so they started buying. It went up, but it's a blue one. It's a blue bar. Remember, we don't do anything on a blue bar. We wait for the next one. So, but it did allow us to set a support level right there. Now, what happened the next day after earnings? Uh-oh, look at that. Netflix dropped all the way down there. So we are not going to do anything. We're just watching. Those are red, blue bars. What we're waiting for or looking for is a new low. Will it make a higher low or a lower low? So we need to identify a low first before we can start to figure out what's going on. All right, so there's might be a low. There's still blue, still red. All right, there's a green one right there. So that is a new low. So we're going to draw a low in right down here. And I like to use the close typically to do these. So there's a new low. That might be a support level. We don't know yet. We don't know until we get two of them, but that might be the support level. All right, so now we've got some green bars. It's going up, but it's coming back down. So could that be our support level? Oh, there's some green ones there. So this looks like it probably is a good support level. So let's continue this across. And at the same time, let's draw a resistance up here at these highs. So now we've got a range that is trading in, but we're not ready to buy it yet. We're just watching to see what's going on. By the way, the other thing that we are going to do is we're going to put in right up here, that big gap. We're going to put a line in where that gap is because gaps a lot of times get filled. So we want to see if that gap will get filled. So let's continue day to day as we go across. That's coming back down again, back down, but now it's going back up. Look at that. So if we draw our line across, this should be red. We'll draw this line, which is a resistance line, and you can see it's now broken resistance. And we now, it looks like we have a pretty good support line. We've got 3 times now it's come down there. So this looks like, and look at the volume. That's the other thing to look at. So volume is picking up dramatically. All right, so this now is our buy point. So we're going to put a buy in right here. and we're going to only buy 50%. So 50% of our full position we'll buy right here. Well, you'll understand that better when we get to the risk management part. So there's 50%. That's our first buy. And we'll continue to watch and see what it does. Looks like it's heading higher. So we're going to put in a stop just below this, which is now support, by the way. This is now a support level. That's where we'll put our stop in. All right, so let's watch it some more, see what happens. It's coming back down, coming back down. And it hasn't broken through this yet. So we're going to draw another support line down here at the bottom. Put it right in here. And we're going to draw a resistance line up here because now we've hit that twice. All right, let's see what happens. Continue to go across. Support line looks like it's holding. Will it break through resistance? We've got a green bar right now. And right there, we've got a gap up, broke through resistance, and look at volume down here. So that's where we're going to put our second purchase. So buy number 2 will be right there. This will be 25%. And now we'll continue watching. So now we've got 2 purchases, and we can now move our stop up to this level. We'll see if this, by the way, we can also put in a gap right here because gaps often get filled. Looks like it's going to get filled right there. So it comes down, kind of filled the gap. Still going up, still going up. Now at this point, we actually have a horizontal, or I'm sorry, a diagonal resistance line. You can see it right there. So there's a resistance. We'd like to see it break above that. And in fact, now that we're above all of these levels here, this gap fill right here becomes support. So we put a support line in right down here. And continue watching as it goes up. And now we can move our stop up to this level. So now we've got 2 purchases. One of them is in the money. The other one is slightly out of the money. Continues going up. We have another resistance line up here. Right there. And we also have volume down here. So we broke through this resistance line. We've got a green arrow. So our final purchase will be right here. That's our final 25%. Now, what's it going to do? So now we're 100% in. Continues going across. Looks like it's heading back down, so we can put a resistance line in up here. What we want is to see if this resistance here is going to hold. Because our stop is still down here. We can move our stop up. In fact, we could put a support line in right here. All right, let's see what it does. Comes down, did not quite make it down to that support line. So let's move this one over. By the way, remember how I said gaps often get closed? You see that big gap over here when this big sell-off happened? Look right here, traded right up to it. That is resistance. So the resistance was created by this gap right here. Traded right to it and came back down. Went back to it again and then finally broke through. So that confirms our 25%, our final purchase right there. So that gap was closed. So as we continue moving sideways, hasn't taken anything out yet. So we can move our stop, this stop here. We can move it up to here. Now we're in the money on 2 of them. Now this resistance line gets broken right there. So we can move our stop now up to this level, which is actually a support level. And then take it all the way out to where we are. This is Friday right here. So right now, based on that, we can move our stop up to here. In fact, I would put a support line in right here at about that level. And now, because we've had such a move, we might want to get more aggressive with our stops and move them up closer, expecting to eventually be taken out if this rolls over, but we can move our stop all the way up there. So that is how support and resistance works. That's how the big traders do it. They create the support and resistance lines. They look for gaps. They scale in. You could have gone in at 100% right here. This was a huge volume day right here. So you could have just gone in at 100% and just kept moving the stop up based on resistance and support. Now, what if we then want to add moving averages? So this is all you really need.
Hey, Dan,
yeah,
quick question. I want to tie this now complete story with some of the earlier talk to make this visual more important. The colors on these candles, again, red, blues, and greens. What is doing that? What is that again? Remind folks.
Yeah, that's the Elder impulse system. You can find this in stock charts. I'm not sure if it's in other platforms or not. Essentially, if it's green, it means it's above its 13-day moving average and momentum is moving up. Both of those things have to be true. All right. So it's trending higher and it has momentum as it's trending higher.
Right.
If it's red, it's the opposite.
Right. And you went through that earlier. Just again, everybody watching this is going to get the video and the PowerPoint, so you will be able to consume this at your leisure. The other thing I want to point out here is you did a 50, 25, 25. That is really up to the investor's choice. This is what you've been teaching me. Don't go all in at once. Yep. Use all this. You've did it here as 3 purchases. It could have been 4. It could have been 2. It could have been 1. That's the investor's call. And then second, you use some vocabulary that I think might confuse experienced folks. You called it in the money. That typically is for options. This was
no, I'm sorry. That's I didn't mean to imply that this was an option strategy, although it could be.
This was all stocks. This was stocks.
This is all stocks, but this could be used as an option strategy if you were a longer term option.
Yeah, let's not confuse anything. This was Netflix, the stock that was being
Netflix the stock. This is just buying the stock, not the option. But what I meant was the stock price was above our buy price.
Yeah, basically. You were money good. Yep.
Right, exactly. I think I calculated this on average. If I did the 50, 25, 25, I think the average price point was around 250. And right now the stop is at 400. So it's about $150 in profit using this method.
Yeah, there's a couple of things. Again, we'll get into this more in the risk calculator that you've been teaching me, and maybe it'll benefit others. One is position sizing, which definitely be in the risk calculator, but the other one is managing your stops. Not only your stop at your first purchase, which clearly I've always understand, if not always done, but moving your stops up. That was a big help that you've given me. So I liked how you walked through this. So thank you for that.
Good. So the next thing I want to do very quickly is add in moving averages. All right. So I'm going to start with a simple moving average. And what I like to do is on 50-day or higher, I like to use a simple moving average. So I'm going to have a dashed line and I'm going to make it gray. Remember my colors from before. So 200-day is gray. So there's the 200-day. Now notice Netflix, remember the whole market was going down back here. Netflix reported and dropped like a stone. The 200-day moving average was still going down. It had not bottomed out until way over here. So 200-day is slow moving, but it's also a great way to stay out of trouble. So you could have had a strategy that said, if you were very conservative, that said, I will not buy until it goes back above the 200-day. All right, which would have been right over in here. Now, many times a stock will come back to support and then take off again. Remember, where are the orders? That's the whole idea. That's what you want to be thinking. Where are the orders? So that's the 200-day moving average. Let's put in a 50-day. It's also simple. 50-day dashed line and red is my color for 50. So there's the 50-day. Now you can see where the 50 crosses the 200. You can also see where the price went above the 50 back here, came back a little below it right here, and then it gapped up right here. So that's where it crossed right there, around the same point. Now let's add in the 21. Now the 21 will be an exponential moving average. Now, remember, I like to use, the default on most platforms is 20, but I like to use Fibonacci numbers. So 21-day moving average is right there. Now we can see that the 21 crossed the 50 right down here, right almost exactly where we bought. You can see that right there. And then it went up, it came back and touched the 50, went up, touched the 50, and didn't go back through it until way up here. All right, and we were keeping our stop, remember, way down here to see if this support level would hold. So we never got stopped out, even though it was above both of these buys. But the 21-day came below the 50 and then went above it and has never gone back below the 50 since then. And then finally, the last one that I like is the exponential moving average, 8-day moving average, a solid line, and I use pink as my color. So I use this on all of my charts, so regardless of what time frame, they are all the same. Now it's very interesting. Look right here. The 8-day, the 21-day, the 50-day all cross at exactly the same time. Right here. Basically 2 days before it broke through this resistance level and I made my first purchase. So again, that's just confirmation. The support and resistance should be the first level that you look at, but this is a great way to identify confirmation by using the moving averages. And you can see the 8-day is the faster one, so it moves much more quickly. And if you have all of the fast ones above the slow ones, then it's a very bullish chart. Finally, the last thing I'm going to do here is I'm going to add in the RSI. So relative strength ratio, I'm going to put this above the chart. And in this case, I want to make it green. And I'm going to add, this is a little bit deeper, but I like to add the money flow index, and this will be right behind the RSI. So when we put that in, now we can see, let me make this a little bit lighter. Money flow, I'm going to have opacity of 0.3. So it makes it lighter, puts it behind it. So the RSI, relative strength, identifies the strength of this particular symbol. In other words, how strong is it based on its past performance? The MFI, the money flow index, kind of does the same thing because you can see it kind of mirrors it. However, it uses volume. So a lot of times it will move faster or before the RSI will. So I like putting them both together so that I can see what they're doing. Again, anytime it's all the way down here and starts to come back above it, that is very oversold and beginning to start to trend up. And that was right down here at the bottom, down here. And then the final one I want to put on here is another momentum indicator, which is the PPO that I like to use. It's the same as a MACD, so you can also use a MACD. And again, I like Fibonacci numbers. So I use 34, 8. The thing that makes the PPO different from MACD is that it uses a percentage rather than the actual price. So it is easier to compare two different charts. If you're looking at a $100 chart and a $10 chart, it's easier to compare them using percentages instead of actual numbers. So that's why I use the PPO. And then I put a stochastics behind it to see what that looks like. So the PPO is a momentum. It will tell you, what the strength of it looks like, but it doesn't tell you oversold or overbought levels. The stochastics will tell you oversold and overbought. So now if we look at this, we can see down here the PPO crossed right here, right in this area. So that's our first confirmation. Now I want to see if it's going to break through resistance. So that's the way, this is the way I typically set up my charts. So hopefully that was helpful. Basically combining all the things that we just learned on technical analysis, putting it all together and doing it in real time.
And again, folks, as promised, when we talked about this session, you're going to have to watch this replay a couple of times. I know I will. There's a lot there. So thank you for doing that.
This last one, before I get to the risk calculator, I'm going to do this pretty quickly, just for curiosity. Could technical analysis have shown us where to get out before the last big turn downs? Here's the .com bear market. All right. So there's the resistance line right there. Kept going up and testing it and never broke through. Here's where VectorVest gave its confirmed down. This is where the moving average is crossed, 821 and 50 all crossed right there. So and this is where the PPO crossed. So there's warning number 1, there's warning number 2, then it dropped below the 200-day moving average. There's warning number 3, then it dropped below this support line. There's warning number 4. And if you needed more than 4, it went down and started coming back up, but could not get above its 200-day. So there's 5 warnings to get out of this stock. What did it look like? There you go. Here's the warnings up here. And there's the bottom. So could technical analysis save us from all those big downturns? Here's the financial crisis, 2008. Here's where the PPO crossed right here. Here's where VectorVest gave us confirmed down. Here's a diagonal resistance line that it couldn't get above. 3 of the moving averages crossed right there. It dropped below the 200-day, came back a little bit above it, but went below it again, tested it right there, tested that. Now it's tested this resistance line 4 times and got rejected again. So right there, January of 2008, if you didn't heed all of these warnings, multiple warnings right there to get out, right? That would have been the time to get out of it. So that was January 2008. There's what it looked like. The bottom was March 2009. And then coming back up, you see the moving averages crossed again. You can see the PPO actually is slanting up. It got above the 200-day. So it depends on, what your risk tolerance is. Gets above the 200-day, you could buy in right there. Finally, not quite finally, COVID crash. COVID came across here. This is February 2020. Went up and hit this. Now, in this case, there's a negative divergence. I love looking for these divergences. They don't always happen. But you can see the RSI was making a lower low at the same time that the price was making a higher high. So there's warning number 1. Warning number 2 is the PPO and VectorVest down signal. Warning number 3 are the moving averages crossing. Warning number 4 is dropping through this support line right there. And warning number 5 would have been the 200-day moving average down here. In this particular case, I got out on this one right here that dropped below this support line. That's where I sold everything, right here in the 3rd week of February. And then you can see what happened after that. So there's what happened. There's where we are now. And then this is the recent one in 2021. This had a head and shoulders pattern on it. This also had a negative divergence, which I talked about on our very first call. So the price was hitting a higher high. PPO and RSI were hitting lower lows, crossed all the moving averages right there, went below the 200-day right there. And there's the resistance line. So you should have been out there. And this is basically where we are right now. That's where we are at this point. So being a little late in a trade is insurance that your opinion is correct. Can you time the market? I would submit yes, you can time the market. Can you time the exact bottom or the exact top? Absolutely not. Unless you're really lucky. you can get the actual bottom and top. But I don't want to get the bottoms and tops. I want the 80% in between. That's what I'm looking for. All right, so now we're at risk management. So we made it through the first two sections. How are we doing on time? Pretty good. Let's talk about risk management. Marty Schwartz again. Traders focus almost entirely on where to enter a trade. In reality, the entry size is often more important than the entry price. And that's what risk management is all about. It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. Really, really important. Mike, you remember that in 2001, right?
I do.
So Sun Tzu said, every battle is won before it is fought. Plan the trade and trade the plan. Just like in war, planning ahead can often mean the difference between success and failure. So you have to understand where your stop loss is. You have to know that going in. Before you ever buy, you should know what your stop loss is. That can either be a mental stop loss or you can actually enter it so that as soon as it hits in your trading platform, it executes. And you should know what your take profit point is. It doesn't always mean that you take the profit at that point. You just know where your take profit point is. And if the stock continues going through it, you move your stop up to that take profit point, and then you just ride it for as long as you can. Unsuccessful traders often enter a trade without having any idea of the points at which they will sell at a profit or a loss. So successful traders size their positions. By the way, this book is in the book section on my website. So, and that's open to anybody. You don't even have to register on my website. The book section is open for anybody. I've got a number of books that have helped me a lot. So that's out there too. So there are three rules that I use. The first one is one that's often mentioned. In fact, you can get free risk calculators on the internet that will use the 1% rule. You just enter in this information and it will tell you how many shares you can buy. So the 1% rule basically says if you have an account balance of $10,000, 1% of that balance means $100. That's the total risk that you should have on every trade, $100. And what that means is the stock price is $10. You always have to know your stop loss before you go in. So your stop price is 9. That means the total risk is $1 times 100 means you can buy 100 shares. That's how it works. So that's the 1% rule. The account rule, 20% rule. Never risk more than 20% on any one trade. Now this one can be a little bit fluid. You can change that to 10% or 5%. Essentially what it means if you're using 20% is that you can never have more than 5 open positions. So you can move that to 10%. I usually use 20% in a bullish market. I usually use 10% in a sideways trading market. You could go to 5% if you want to have 20 positions. So it's the total portfolio size. What it means is if the one stock that I buy goes bankrupt tomorrow, then I'm only going to lose 20% of my portfolio, not everything. And then finally, this is one that a lot don't use or aren't even aware of. It's called the ATR rule, the volatility rule. ATR is average true range, or the range that a stock moves in a particular day from top to bottom. It tells you the volatility of that particular stock. And by using volatility, you can also put a rule in that helps you size your position based on the individual volatility. So this will change for different stocks depending on how volatile they are. All right, so that brings us to the risk management. So I'm going to go into the risk management now. And I am going to actually show it to you and actually build one out. So I'm going to use...
And just real quick, Dan, this is something, folks, if you go back to Dan's playlist on the YouTube channel, he and I went through this probably 5 or 6 times with my actual portfolio and my actual trade. So you'll see, you're going to see it once here. You're going to get the PowerPoint, but there are other videos of him explaining this if you want to consume more, because this critical information, but also a lot to consume. It took me 3 or 4 iterations to truly get the power.
Yeah, I'm just going to show 2 examples here just so you get a sense of what it does. Roland Crespo, I notice, is on the call. He got it in the very beginning, way back, I think, when we first started talking, Mike. And he's going to talk about how this has really helped him. He gave me a great testimonial, which is on my website if you want to see that too. So I'm going to use a couple of stocks here. And there's a number of ways that you can determine which stocks, but I just did a couple initially. I'm going to do Palantir and what's another one? Give me a stock, Mike.
Why don't we do Apple?
So on the first one, I'm going to use an account. Let's say this is my trading account. And let's say this is my IRA. All right, so this is Palantir. My account, my trading account size is, make it 20,000. And let's say my IRA size is 100,000. Okay, so in Palantir, the first thing I need to know is what is the ATR? What's the average true range? So I'm going to have, I've got a little button here that you can click. Once you put the symbol in, click that button, and it will show you a chart of Palantir. It will actually draw the lines in. This comes from FinViz. It will actually draw some resistance and support lines in. There's actually a pattern there for those of you that recognize patterns. That's a bearish wedge that usually results in a downside movement. But on this, it has the ATR right here is 84 cents. So the ATR for this is 84. So I put 84 in here. And then the next thing I do is say, where do I want to buy this? So right now it's at 1640. Let's say I want to wait till it gets to 1650. Let's say I want it to be going up. So I'll say 1650 is my buy point. Now, the next thing is you have to always have a stop. So you can't use this without knowing when you're getting out of this particular stock. There's a lot of different ways you can do it. You can look at the chart and say, oh, look at that, 14 looks like a support level. Now that we've learned about support. So I could put it at 14. Looks like there might be another support up here, 1538. Or you can let the calculator figure it out. And what it does is it uses 2 times the ATR. So $1.68 and subtracts it from this and says 1482 is 2 times the ATR. And that actually looked like a fairly good place to put it, 1482. And that means I will lose 10%. If it gets taken out, I'll lose 10%. The other way you could do it is just a straight percentage. So let's say I always want to have 7% going in, my initial stop loss. So I put 7% right there. And now it says my stop can be at 1535. Now notice what happens with the number of shares. This is the most important part of the whole calculator. If I use 1535 as my stop, I can buy 120 shares. If I use 1482 as my stop, I can buy 110 shares. Okay. Now, since this stock is, fairly low priced, 1650, I'm just going to let it go with that. I'm just going to buy 100%. So there's the number of shares I can buy. What about Apple? Let's look at the chart for Apple. There's what Apple looks like. Very nice uptrending chart. It also has somewhat of a bearish wedge. I'm not sure that's a really good one though. But the ATR for Apple now is $2.65. So I put the $2.65 in here. And the price for Apple was $190.69. Let's say I want to wait for Apple to come down to 189. Let's say 189. I want to see if it'll come down before I buy it. So I'll make that 189. By the way, you can also put a percentage. So if you wanted to wait for it to go up 1% before buying, you can put a percentage. If you wanted to wait for it to come down 1% before buying, you can put a negative 1% in there. And it will automatically calculate your buy price for you. All right, so now where should my stop be? Well, using the calculator, it says 183.70. So let's try that, 183.70. Put that right there. That's only a 2% loss. So if I use 7% over here, 7% over here, sorry. This is 183.70. Now I can put my stop at 175 with a 7% loss, or 183 or just a little less than a 3% loss. So let's look at what those actually look like. Wants to give me an ad instead. All right, so right there, that looks like a support line right there. It's at 186.75. So 183 actually is pretty good. 174 is way down here. So I actually think that the 183, which is way down here, is actually a pretty good stop. So that means that I'm only risking 3% of my portfolio. In this particular case, either way, I can only buy 50 shares. All right. So let's say I want to scale into this with 50% initially. So now it's 25 shares that I buy initially at 189. And let's say I want to buy another tranche if it goes down 2% more, negative 2%. Now it's 185.22. So I buy the first 25 at 189. I buy the second 25 at 185.22. And down here, it calculates what our new cost basis is. It's 187.11. And also recalculate your stop prices. So now instead of a stop of 183, now it's down to 181. So that's 2 entries. I can put a third one in if I want to. Now, the final thing I want to show on this is this little red box up here. This is your exit criteria. So let's say on Palantir, I want to exit at 10% profit. There, 1815 is the price. So for Palantir, 1815, what I want to make sure is it reasonable for it to get there? And that's pretty high up. I mean, there's resistance right there. So if it really has a good run, it could get to 1815. Let's look at Apple. Apple is making new highs. So Apple, could go anywhere. For Apple, if I want a 5% profit, it's 198.45 is where I want to set my target. Again, if it gets there and goes through it, just move your stop up. That way you can at least lock in that amount. The other way to look at this is the R value. This essentially is a reward to risk ratio. So if I want a 2-to-1 reward to risk, then you can change this R value right here, and it will tell you what the price should be. And it is based on your stop losses again. So a 2-to-1 ratio for Palantir, 1986, if it gets there, I've got a 20% gain. Or using this stop loss, 1881, I've got a 14% gain. 2-to-1 over here with Apple, if it gets to 197, that's a 5 and a little more than 5% gain, or a 14% gain here. So not only will it show you your stop, not only will it show you your number of shares that you can purchase, it will also show you where your target exit prices are. So you don't have to stay in the stock. I use this every single time. So my account value basically stays the same. If my trades are successful, then every time I go back in, my account value goes up, becomes higher, and the number of shares goes up as well. If I have losses on some, the account value will go down, and this will go down. So it all is based on that. So the only 3 things I need is the account value, the ATR, which you can figure out using this, and the stop. What price am I going to get out at? And it will automatically tell you what the number of shares you could buy, the position size should be. So before I move forward, I want to introduce Roland Crespo, who used the calculator right from the very beginning. And Roland, I'm going to use your slides. So he sent me these, and he was gracious enough to allow me to show them to everybody on the call. Do you want to talk a little bit, Roland, about this? I can step through the slides as you do.
Yes, good evening, everyone. I'm in Central Asia right now, so it's about probably 10:15 p.m. Very glad to join the call this afternoon over there in the East Coast. Like Dan mentioned, I pretty much started following his videos with Suber since December 2021, but very, very late in December. If I don't recall wrong, was 3 or 4 days before New Year's Eve.
That was the very first one we did, Roland. Very first one we did.
Right, and starting that day, you introduced your risk calculator, and I did not hesitate to reach back because, but by no means I ever traded anything before. I did mutual funds, 401k, Roth IRA, you name it, right? But never had to play with trading stocks, and wanted to explore the risk calculator. And as you will see here shortly in a few slides, there's not too much action the first 6 or 7 months, but it's because I was doing paper trading. Okay, I'm still by far at the level that I would like to reach as far as a trader, but following Dan's shows every week, the conversation with Suber, his books recommendations, my first 6 to 9 months in this 90-month journey were pretty much doing a lot of paper trading, getting comfortable with losing money, right? And doing a lot of literacy on trading psychology. The other thing that I implemented early on was a trading journal. And that's something that each of us will need to figure out one way or another, but it needs to be a system along with this trading risk calculator that you can do like a historical, I guess, data collection. So that was very helpful for me. I have a trading journal that resembles a lot of the data that the risk calculator pretty much tries to gather or sort of like looking into the possibilities, right? I have a trading journal that it resembles many of those factors. But I guess that's a combination, right? The Michael Douglas has excellent videos on YouTube, and that's thanks to you, Dan, who brought it up early on your videos. So I became immediately a big fan of Michael Douglas with his trading psychology and his approach. So here what I want to show you is this is very real. I started pretty much very raw. I think my first trade way back was a huge mistake. You know, I'm pretty sure I bought Facebook or Meta at the top, right? And immediately became a loser. And I had no idea even what a stop was, but I was already putting my money at risk before any of this understanding came to place. So that's why you see like a plateau here. This first slide goes the entire 19 months I've been doing this game. And also kind of like with the trend of the market overall, 2022 was a pretty rough, bearish year. And my money was not doing so much because my stops were kicking me out of the game, right? By using the risk calculator, I was constantly kicked out. And it could be a little bit frustrating at the beginning, but I'm just trying to trust in the system. If these gentlemen are telling me to do it this way, I will continue doing it. And little by little, I start getting small profits, right? I mean, those targets were met, and because it was such a bearish year, the trial and error, I decided, well, I'm gonna take a small losses, 3%, 4%. I'm sorry, gains. I'm gonna take a small gains. So I needed to be comfortable with taking a small chunks of percentages. It's all about the percentage, that 3-4%, and then put my money back to work. And if you show us the next slide, then
Yeah, by the way, Roland, on this one, this is a really good example of when the market is going down, if it's trending downward, then your stops should naturally take you out of everything. You should end up at zero if you've got your stops in there. It'll just take you out. Yeah. And then you'll still have your capital to invest when the market starts to go up, and then it will take off.
Yeah, I think
that's
really
exactly what happened.
I think what's really interesting here, Roldan, is 2022 was obviously a rough year for the stock market. You try to start learning the game in a horrible market. You trust the system. You have stops. I mean, how many of us would like, small losses from 2022? A lot of us got really, really wrecked in 2022 because we weren't following a system. We didn't have stops. We thought we knew better, all of that. So, I mean, taking some small losses in 2022 and earning your stripes, good for you.
Yeah. And you could see it here from pretty much January 2022, my account was in zero. My first deposit were $1,000, pretty much just to play with it, right? But if you see pretty much those first 9 months up to September, there's tons of red there. Actually, pretty much like even November. It's not until November that I start getting some momentum and see a little bit of between the losses and some of the returns that I start getting to the other side. And 2023 has worked tremendously. This is the last year, right? This is the last 12 months here. If you go a couple of slides back.
I thought I had more slides in here for you.
It was 6. I did first 3 slides of the overall 19 months and the next 3 slides.
Oh, I see. I've got double slides in here for some reason. Sorry about that.
But overall, the last 12 months, my money has produced close to it. I think a little bit over 38% return of my initial capital, which I don't think many people can speak of doing that these days. And even more when the media tells us constantly that the market is about to crash. And I can tell you that I mean, if it's not because of what you put out every week, Dan, and the discussion with Super, I probably would have never had the courage to start. And now, the other thing is not stressful at all, guys. I use the risk calculator. I trust what those numbers I plugged in tell me that I need to make those transactions, and I set those parameters. A very simple account on a very commercial platform, nothing too fancy yet, and it does the job.
And that's really the key is being able to do it without worrying too much, and that's all about position sizing, making sure that even if, like I said, even if that company goes out of business, it's not going to take you out of the market. If you don't have any money left in your portfolio, then you can't do any trading. So small losses and large gains is the key. The way you do it, and you have to get used to the idea of losses too. I mean, I think it was really good what you said about the psychology of trading. There's one book on my book page called Thinking in Bets, which is actually written by a gambler. Can't remember her name, but she says, you'll have a string of wins, and you'll think it's
Annie Duke. I think
Annie Duke. Yeah, Annie Duke. She said you'll have a string of wins and think that you're invincible, and then you'll have a string of losses. So if you flip a coin 100 times, you're going to get 50-50, right? But you might get 6 of those will be heads, but the next one will be a tail. You have to be prepared for that. You have to recognize that. So don't get too overconfident when you have a lot of wins, but just be cautious and follow the process and watch the charts.
Exactly. That's the bottom line. I think that's my biggest takeaway. I followed the process even when I had no clear understanding why I was following it. But if other people who are making money out of the market tell me this is the way of doing it, well, let's give it a shot. And it proved to be right.
Right. Thank you very much.
Thanks, Roldan. That's very, very brave of you to share your story on a public forum like this. So, Roldan, thank you very much for that. I got to remind you,
Roland and a few others have sent me emails and asked me questions and asked me ideas and that type of thing. I'm not going to give you stock recommendations. I am not a financial planner. I don't have a license to do that, but I can help you with educational process to help understand the market and understand what's going on.
Yeah. So Dan, I want to remind you of our time constraints. We want to try to give an hour to stocks. You've got 40 minutes for section 2, just a reminder.
Yep. Yeah, I think actually I won't need all that. So the next section that I want to go through is the platforms that I use. So number one, and you've seen these all the time, stock charts, and some folks have asked me what the cost of these are. So these are the monthly amounts, and I put in what the yearly amount is. I'm an extra member, so I'm in the center one right here, $2.99 a month, a year, basically. Stock charts allows you to buy ahead. So many times they will have specials. They'll have specials around 4th of July, and they'll probably have one around Labor Day, and they'll have an end of year special and things like that. And usually when they come out with specials, I'll go ahead and buy it. I think I've got a subscription now out to like 2026 or something. But that's the annual membership. I haven't seen a need to go to the pro level. The only thing I bump into are the number of scans that I can do. So there are 200 scans allowed on the extra level. And I think I'm at like 199 right now. But a lot of that is because I create scans a lot of times just to experiment with stuff, and then I just forget to delete them. So every once in a while, I have to go back in and purge some of those. The truth is, I probably only use maybe a handful of scans now because I've really modified them down to the ones that work. So I don't have to use a lot of these, but that's the only level that I've really bumped into with the extra level. So I've never really found the need to go to pro. Let me jump into stock charts real quick and just show you guys. You've seen this that I've worked with. So this is my standard chart. I'll show you a few shortcuts with stock charts. One is it gives you these buttons over here on the left-hand side. So once you have a format of a chart that you really like, you can save it. So I have one saved as my default. So when I click on that button, it automatically gives me this chart. The next one down is I have a weekly, because I always like to look at the long term. So let's look at one that everyone's familiar with. Actually, let's look at Netflix just for fun, because I've been using that one. So there's Netflix. That's the weekly chart. This is the Elder Impulse, the one that I was showing in the example for Netflix. Sometimes I like to look at it this way. It's just a little cleaner view. This is basically the one that I was showing you before. I then have one for a PPO format, which is essentially Tom Bowley's format that he uses. So basically, I've created Tom Bowley's format right here in one of these buttons. The squeeze is one that I think is really interesting because this shows the Bollinger Bands. I'm not going to get into what these things mean. You can research them, Google them or whatever. But Bollinger Bands gives you a sense for volatility. When these start to contract and get narrower, then volatility is going down. And when they come inside of the ATR, so each of these levels here are the ATR levels. There's 1, 1.5, and 2 ATRs. Actually 3. 1.5, 2, and 3. So 1.5 is the one in the middle, 2.5, and 3. And whenever the Bollinger Bands get down inside of the 1.5, then volatility is really low and it's probably ready like a loaded spring to take off. And that happened right in through here just before this big takeoff right there. So I like to look at that one. And down here shows you the Bollinger Band widths, again, showing you volatility. So when this goes down towards the bottom, then volatility is very low. And when it gets up near the top, volatility is very high when it gets to the top of its or bottom of its Bollinger Band. Relative strength is really important. This is one that I always look at, especially before earnings. If I'm thinking about holding a stock or buying a stock before earnings, I want to look at the relative view. So this is what I mean by intermarket relationships. This is the kind of thing that a lot of technicians don't do. It's kind of unique. It's something that I learned from Tom Bowley, but it allows you to look at this in different ways. So it's a relative chart. So this is part of, Netflix is part of the communications sector. So this first one shows me communications sector versus the S&P. If this is trending up, that means it's outperforming the S&P. And I want things that are outperforming the index. The next one is the industry group that it's in. So this is just the industry group for Netflix, and it's outperforming. The next one is the industry group inside of its sector. So how is Netflix's industry group or Netflix's peers performing in its own sector. And it started to underperform a little bit, and then it started to bounce back. This blue one is probably the most important one, especially before earnings. How is Netflix doing versus all of its peers, versus the other stocks in its own industry group? And right now, you can see Netflix was underperforming its peers, and then it started to outperform its peers, and it started to come back a little bit right now. And then finally, Netflix versus every single stock in the market, 9,000 stocks out there. So it shows you how Netflix is doing versus everything. So that relative view is really important. If I wanted just a long-term 200-day moving average, if I was a long-term investor or I wanted something for my portfolio that I'm gonna hold for a very long time, I wanna make sure it's above its 200-day moving average. So that lets me do. And then if I'm a short-term trader, a day trader, or an options, or even more importantly, a futures trader, I'll look at a 15-minute chart. So I can see what it's doing in a 15-minute basis. And this is, I'm not recommending this for folks on here, but if those, because I've had questions from people, what about day trading? What about futures and that type of thing? The importance of those, the number one important thing is market psychology. So you need to read those books and learn about market psychology if you want to be a day trader, because it can be brutal when you're wrong, and you don't want to be right. It's not about being right. It's about making money. But this will show you a very short-term view. So these are 15-minute bars right here. So it can help you on a short-term basis. The other thing about stock charts is you can create scans, which I've created a number of. I have a dashboard here. It shows me all my best of the best stocks right here. It shows me which ones. This is something that I put together every week. And then it shows me the best industries. So every day I can see what's performing. And I can run scans down here. So if I want to run a scan, for instance, on 8-day crossing the 21-day moving average. I've got 3. This is using my best of the best chart list. You see AMD sold off on Friday, but actually the 8 started crossing the 21. And then another little trick on stock charts, if anybody has this platform, is after you do a scan, you've got a list of charts right there. So you can save it to a chart list. And what I do is I say replace list, and I have one chart list that I've named that ends up at the very top of my list, just called scan dump. And that allows me to dump all of these charts into one temporary file to be able to do things with it. So now I can see, how is it doing technically? So the best technical one is AMD. How is it doing for percentage change that day? But I can also look at these in a different way. So I can do a summary. I can do a chart book view, and this will show me each of these stocks using my default. There's that shooting star candle that I mentioned before that all of these semiconductor stocks had on Friday. That is a bearish candle. So people were buying all the way up here, and then they started selling off the rest of the day. So that's not a good look. So you've got to be careful next week for another number of reasons. But I can step through each one of these using my default chart. So there's Google. So Google looks like it's getting ready to break out right there. PPO is crossing. Here's Google again. It's the other Google. Same thing. See, the PPO is about to cross right there. So this is a way that you can research. You can do scans. You can research stocks. Create a list called scan dump and name it so that, with something in front of it, so it ends up at the top of your list. And then once you do a scan, just dump everything in there. That lets you work on this in different ways. So this is stock charts. One thing that I do in stock charts is I take Tom Bowley's list, which I'll show you in a second, and I put all of those in stock charts in a list called earnings beats. And that allows me then to have, for instance, Tom does, I'm going to show you his platform here in a second. Tom does a lot of research on things like, which stocks have the best earnings, which I think is a really good one. So strong earnings chart list. He will put that together on his site. And if you are a stock charts member, you can download it automatically and load it right into stock charts. So every time he changes this, which is about every 2 weeks, strong earnings identifies those that have just reported earnings, have beat on earnings, have beat on revenues, and have good prospects going forward. So he does all that research for you. So that fundamental part, this is part of what I do. I put this together. There's a number of other things I do. I'll show you in a second. All right. So this is Tom's full list. He actually, this is his list, and he actually annotates these and shows you different things. So there's lots of different ways you can do that in stock charts. There's also chart school. So if you want to learn anything about candles, about charting, scanning resources, anything like that, you can just type it in there. And there are articles from contributors out there. Tom Bowley is one of them. Here's his right here. So if you want to read all of his articles as they come out, you can do that. Click on there. That's in the articles. And then charts and tools gives you a whole lot of different tools. There's a lot of things in here. The market summary report I'll look at a lot of times just to see what the market is doing, or the sector summary report is one that I'll use, like I showed you in the beginning. You can see on Friday, healthcare was the leading sector. If I click on that, it shows me the leading industry groups inside of healthcare providers. If I click on that, it shows me the leading stocks. United Healthcare was the leading stock in the leading industry, in the leading sector that was leading the market on Friday, United Healthcare. So it's a way that you can narrow these down to identify good candidates. All right, the next thing I think, so that's stock charts. Next thing I think was, this is VectorVest. So VectorVest, the cost of VectorVest is $829 a year for basic, $1189 for enhanced, $1789 for premium. I have the basic, so I don't, the premium, the other two will give you some technical analysis components, but I like doing technical analysis in stock charts instead. I think it's a much more powerful platform. So I just get the standard, the basic one from VectorVest. And VectorVest, show you what that looks like. I actually show this in my newsletter every week. By the way, for those that get my newsletter, I really encourage you, if you don't do anything else except for read the cartoons, don't do anything else, just go look at this, the front page of VectorVest. It's sort of like a newspaper. It's like, what happened today? And it shows you, what their rankings are. It shows you it's a confirmed up. It shows you the buys versus sells. This is for 9,127 stocks. The number of buys, 26% buys, 14% sells. It shows you the advancers and decliners. But more importantly, it shows you the top 12 stocks in VectorVest's universe of 9,000 stocks. SMCI is the #1 stock out of 9,000 stocks for VectorVest. If you do nothing else but write down or create a watch list of these top 12 and just watch them using the fundamentals of technical analysis that I showed you before, wait for them to come back down to a support level and then buy them, you can be hugely successful just doing that. Just the top 12 VectorVest stocks. But VectorVest also will do many other things. You can also, there's a views that has this, I put this in my newsletter, but there's a lot more to it than what I put in there. There's a portfolio view. So I create portfolios out here. So I did some last year on dividends. So here's Dividend Aristocrats. I did the top 10. I put this in my newsletter on January 3rd. This allows you to track them. And I created three portfolios, and I'm not touching them. I'm just experimenting to see how they do. This is Dividend Aristocrats, which you can find on the internet. These are the ones that always pay dividends. They increase their dividends. They've done so for 25 years. If they miss 1 year, they have to wait another 25 years to get back on it again. These are the top 10 as of January 3rd. And you can see it's returned 4.89%. VectorVest has its own blue chip dividend. I did the top 10 of those, and this is a negative. And then I created my own scan using a combination of different scans within VectorVest, and this one's returning 3% so far. So I can see the Aristocrats is the one that's actually doing the best. You can also create different scans in here. So one scan that I run almost every day is using my best of the best chart list. I run a scan for the ones with the highest relative value, the highest earnings growth, And in VectorVest, earnings growth means not only their growth on the last earnings statement, but their future projected growth. So it all takes into account future growth as well. Volume over 100,000. And then I'm looking for something that was not a buy. And then for the last 2 days, it gave me a buy. So it has just become a buy. There's only one stock out of 9, actually, I think I had 138 on my list this week. And then I can look at the chart of this to see what it looks like. So you can see right there, it just gave a buy right here. You see the last time that it gave a buy, it continued higher. So I look at that all the time. So you can create different scans in different ways. One thing that I've done is create a complete sector list of all the 11 sectors. And I can see, for instance, with, let's say, communication sector, any new buys in the communication sector? There aren't any. Any new buys in the materials? I've got one, Goldfields in materials. So there's just different ways that I can put things together, and I can search on them so that I can very quickly identify the best candidates. And most of the way that I do that is using my best of the best chart list. So all of these scans, both in VectorVest as well as in stock charts, I use the best of the best chart list that I create every week. And finally, earnings beats. Earnings beats is kind of pricey. So earnings beats is $9.97 annually. It has some really powerful research that he does, which for me is worth it. The biggest one is that strong earnings chart list that I move over into stock charts. And then what I do every week is I take his strong earnings chart lists. I take a couple of other chart lists that he uses. I send those over to VectorVest. I filter those out by the ones with the strongest relative value and the strongest earnings growth. I send them back to stock charts, and I include the top 50 from VectorVest. And I put them all into a watch list. And then I manually look at every single one using VectorVest. So if I look at the top, I'm just going to look at the top stocks in VectorVest. And a lot of these are going to have great earnings. So I'm going to go down. I'll go down here to this one. So what I'll do is, actually, I'm going to take these bottom ones here. So every single week, I'll look at the whole list of all the ones with the strongest earnings. And I'll look at this chart down here. This is earnings per share. And this is the only platform that I know of that I can do something like this. So this shows me the earnings per share of Tidewater. As long as I do this pretty quickly, but I usually have to do it around 250 different stocks. But as long as it's moving from the bottom left to the upper right, that means it has strong earnings. So I keep it. This one is an ETF. This is a great example. This is Taiwan Semiconductor. Even though you would think that would be a strong stock and it's in the semiconductor industry, I delete it from my list because the earnings are going down. In fact, growth on earnings is going down as well. So that would not make the list. This one would. This one would. So I look at every one just like this. This is as quickly as I can go through it. This would stay on. This one I would take off the list because earnings is going down. So at the end of the day, what I end up with is a list of the strongest fundamental stocks that I then can use to apply all of my scans to then identify the ones that are starting to move up. And then finally, the last piece is Stock Traders Almanac, which does a great historical review. And I put these in my newsletter a lot of times, but I get these from Stock Traders Almanac. This one is $2.19 for a year. It's reasonable. It's really meant for somebody that's serious and wants to understand the historical nature of the stock market. Not necessarily for everybody, but I usually will put some of the important information. I put it in my newsletter so you guys will get that too. All right, so almost done here. What time we got? Oh, 15 minutes. The most contrarian thing of all is not to oppose the crowd, but to think for yourself. So remember that when you're watching CNBC, because sometimes what they're telling you is not necessarily the best thing for you. It's the best thing for them to keep you there to watch their commercials. All right, so the very last thing I'm going to do is show my website to everyone, because this is the way I'm going to deliver my newsletter, because I can't do it anymore in email. And I'm going to do this. I'm going to go through this very quickly. And if you're interested, you can sign up for the free weekly newsletter and you'll get it as a PDF. If you don't register and don't do anything, you will get the front page as a disclaimer, has some great testimonials. This is the one from Roland right here. There's an interesting one over here that someone sent me because of all the bad news and doomers. I almost sat on the sidelines waiting for a crash. Because of you, I got in the markets and I'm doing well. This is always on the front page. This is the secular bull market. So you'll know when one of these things changes. And these are all the services and these are the subscriptions. So to get the newsletter, it's free. I don't take a credit card. I don't save or share emails. I don't sell emails. I don't do any of that. It's just for the newsletter. You'll get the risk calculator demo, kind of like what I just walked through. If you want a monthly subscription just to try it out, you can have a 7-day free trial and it's $15. You'll get everything on the website except for the risk calculator. The only way you can get the risk calculator is with an annual membership, $99 a year for annual, and then you will get everything else. And like I said, even if you don't register at all, you can still get the front page right here, and you can get the books page. So on the books page, I have books about technical analysis. I have books about Market Wizards or by Market Wizards, Benjamin Graham, William O'Neill. Here's Bart DeLito, who created VectorVest, John Carter. Here's the books over here from Mark Douglas for Psychology of Trading. I highly recommend, if anybody's interested in day trading or trading futures, that you start reading these first. Best Loser Wins is a great book about how to get your mindset around the fact that you will be losing. You will not always be right. So the key is to lose as little as possible. And when you are right, to make as much as you can. The other ones in here is you get, if you're on the annual subscription, you get all the newsletters. So these are all the ones that I've created that I have PDFs for. I have a section for charts in here that this is unbelievable. Actually, I actually use this myself. But this has all the charts that I've shown to you guys on the YouTube calls. S&P index charts. There's a simple S&P chart right there. I'll annotate these myself with different annotations. Here's one for a daily chart. On this one, I actually put in the VectorVest calls as well. There are the sector charts right here. I update every week. So you can use this to understand rotation. So 1 week right here, you can see discretionary and communications and technology. These are all the 3 aggressive sectors are at the top, but we've also got real estate and materials that made it in for this week. And you can look at, 1 month, 3 months, 6 months, all the way back. You can look at the VIX down here. This is the VIX chart that I show a lot of times, see what the VIX is doing. That's the volatility to help you understand fear in the market. I even put the Case-Shiller chart in here that I put in my newsletter last week to show you, Case-Shiller price index, and shows you the mortgage rates behind it. It's interesting, as I commented in the newsletter, that interest rates right now are right at the median, right at the middle of where they've been for the last 33 years. So all these charts are in here. They're always available. They will always be updated. If you have a particular sector you want to look at, let's say you wanted to look at technology relative to the S&P, remember, if this is going up, a relative chart, if it's going up, that means it's outperforming. So if you want to outperform the index, you want to be in a sector that's outperforming the index. You can then go to the technology, and I separate these by aggressive sectors, these 3, defensive sectors down here, and then breadth sectors, which are the other ones. So you can see the XLI industrials are just starting to move up. also are all of the industry groups. So if I wanted to look at, for instance, semiconductors. So semiconductors have broken through their all-time high, but they're just moving sideways right now. We're going to see what happens next week with these based on what happened on Friday. But all of these charts are in there. They will always be in there. It's a great place to research. If you have a particular stock you're interested in, you want to see what the sector is doing, or if you want to see what their industry group is doing. So if you want to know, with energy, what's oil equipment, what does it look like? Actually looks pretty good, starting to move back up again. And this is relative to the S&P. So it's just starting to outperform the S&P as well. So all of that is in there as well. Chartless and scans, this is where I keep all of my scans. This is where the best of the best fundamentals that I talked about before. I update these every week. So you can see there's 183. Last week there were 235. This is in CSV format, so you can download them into any other platform that you have, stock charts, VectorVest, anything else that you have. And then start running your own scans using that. This is a video on how to set up the standard format, the format that I use in stock charts. And then if you want other chart styles that I use, these are the ones that I just showed you. You can just click on one of these. Like if I like that 200-day moving average one, I click on this. That gives me the one that I showed you. And then I just save it, either save it as a default, or I can add it as a new one. And this will create a button over here in your own stock charts platform. So this gives you the same formats that I use when I look at charts. It gives it to you, and you can just save it to your stock charts platform, and you will always have it there. And then these are the scans that I use. So for instance, downtrend reversal. You click on that, it explains what the scan is, explains how it's structured, and then you can simply copy and paste this right in, just copy it, paste it right into stock charts, and you have a scan in stock charts yourself. Now you do have to change the favorites list because it's not going to this one's not the name of the one in yours, so it's not going to recognize that. So you have to change that one line, but everything else will then give you that scan and you can run it yourself. And the same thing with VectorVest. VectorVest is not a copy and paste type of thing, but I will show you what the search looks like, and then you can recreate that in your own. And I explain what some of these components are. So all of that's in there. It's all meant to make life a lot easier for you to identify opportunities. There's a portfolio one that I just started. These are the dividend portfolios that I just showed you. So I'll update these probably once a month, but it will allow you then to download the symbols that are in that portfolio. It shows you the diversification of the portfolio, and it also will show you a summary report of that particular portfolio and how it's doing. So if you want to track those, that's great. This is something that I'm going to be doing here in the future very soon, is using that best of the best list. I'm going to create some candidates in here using a variety of scans that I have. And I'm going to track these over time to see how that portfolio does. So that should be interesting. And then the risk calculator demo will show you the demo just like I showed you before. You can get this even as a free newsletter member. You can watch the demo to see what the risk calculator does, but you cannot download it. That is on another page, and that requires an annual membership to download the risk calculator, which again is $99 for a year. So that's pretty much everything on the website. I just want to make sure you guys knew what's there and see what kind of value there is. And what time we got? 12:52. Oh, pretty good. All right, so there's my website.
I want to make, you were going to probably mention this later, but I want to make sure we hit it now. We're actually announcing for the folks on this real special.
Yeah. Right.
And basically, I want to personally cover roughly half of your yearly subscription. If you choose to do this, by no means do you have to. Get the newsletter, it's free, all of that stuff. But here's the deal. If you're on this call and you sign up for the $99 subscription, Dan's going to track your email. We're going to cross-check it with the folks that were on this call. And I will personally cover...
Mike, even better.
Good.
I'm glad you brought that up because you're on the call today, if you choose to sign up for the annual subscription, which will then give you the risk calculator, it will come up with a promo code. It will say, what's your promo code? The promo code is 42. 42. It's basically the meaning of life. If you Google what is the meaning of life, it will say 42. So put 42 in as the promo code and you'll get
Dan,
47.
just so you know, is it the number 42 or
The
spelled
number
out?
42. Yeah, it's the number 42. 42. The number 42.
So if you put that in, what's going to
You'll-
happen
It
is you'll
will
get a
deduct
discount.
47 off of this. It'll be 52.
Yeah. And then what I will do on the back end is I will send Dan the $47 for your participation. So again, click on
by
it.
the way, for those that have already signed up for the annual subscription and are on this call or watching the recorded version, in other words, that have paid for this class today, you will also get the 47 back. You won't get the promo code because you've already signed up, but I will send you the $47 if you've already signed up.
So we're going to make it good. This is something we do always at one rental at a time, make everybody money good. It may take us some time to track everything down, but you have a promo code 42. That will give you a discount today. Dan and I will make up for it later because I think Dan deserves every penny of this. And basically what happened is you got today's 3-hour training for free. You're giving Dan the $99. So I think that's more than fair. This video will be posted probably in a couple of weeks because my team will have to chop it up. We will load the PowerPoint. This discount is only for people that paid for this. If you're watching this a year from now, it's not going to work.
The promo code is valid for 4 weeks.
Okay, there you go.
So
4
for
weeks.
those folks that have not attended, couldn't attend today, but they did pay and they will get the recording.
Exactly.
They might see the recording a week from now or 2 weeks from now. The promo code is good for 4 weeks.
Absolutely. So again, I like taking care of my audience. Obviously, I want to see Dan rewarded. Dan has made me a better trader. Dan has made me tens of thousands of dollars already, and I am a horrible, horrible trader. As people watch my experience with trading, it's not good. He has made me better. I thought this was an opportunity to have the audience get a tremendous value and for Dan to win. But Dan, let's get into some stocks. You ready to go? You want to pull up your favorite chart and I'll just start reading symbols?
Hang on. Hold on. We got through everything in 4 minutes left.
Oh, somebody said, hey guys, tried to sign up, used 42 and it gave an error. The
Oh, really?
it says the coupons. That's what somebody said. I'm just, don't blame the messenger.
If that happens.
Coupon use is limited, is exceeded. Wow, you guys are really signing up fast.
What do you mean exceeded? There wasn't any.
Hey man, I'm just reading. I'm you know,
Oh,
I don't
you can
know.
only use it. You can only use it once. Maybe that's it.
Don't know, man. I'm just telling you what was said here. We'll
Maybe
have
I
to
need
figure
to
this out. Again,
I'll look at
folks,
that. I think I know what the problem is. I'll try to fix that after this session. But if you can't use the coupon code, then we know.
Yeah,
I know who you are. I'll have a list of everyone that's done the annual membership, either before the session or after the session, and I'll cross check it with the list of people that have attended. We'll make sure you get your $47.
Yeah, and hopefully I've earned enough cachet over the years. I will personally make sure everybody's good on this if something gets hammered or whatever. You will be taken care of. You spent money once, you're going to get value out of it. So you ready, Dan, for some stocks?
Yep, go ahead.
Let's just do the order that I wrote them down and I can go get more. Amazon was the first one I wrote down.
Amazon, this is my default chart for Amazon. One of the other questions that somebody that couldn't attend but's going to get the recorded version asked me is, could you talk about covered calls and cash settled puts as far as entries are concerned? So that's a good question, and I'll touch on that as I'm looking at the charts here. So here's Amazon. This is the way that I would look at this very quickly. First, the PPO is starting to cross. That's good. The RSI is not overbought yet. That's good. It's above. All of its moving averages are above. So the 8, the 21, and everything's above. The accumulation distribution line looks good. This is the Amazon versus the S&P. It's outperforming the S&P and it's outperforming its industry group. So Amazon looks good. This particular candle is a shooting star. remember people bought all the way to the top and then started selling off. So I would be a little bit cautious. What I'd like to see, and you'll notice this on any bullish chart. This came back down here to be just below the 50 and then took off, touched the 21, took off, came back to the 21, took off, 21, kept going up here, came back to the 21 and took off again. So if this candle implies that there's going to be a sell-off in the market, which I think there actually is going to be the next few weeks, then I would be looking at Amazon at the 21 day. And this is the kind of thing I'll look at. I'm only going to show this on this one and I'll say it on the other ones. But the 21 day is probably where I'd want to make a purchase, but I wait for it to get there.
All right,
Apple.
next, Apple. Yep.
Same thing. Apple's very strong, nice, bottom left to upper right. Notice how it keeps touching the 21 and taking off. 21, by the way, is what I call reversion to the mean. That's where, if it gets too far away from it, it comes back to it and then starts off again. But it's just a steady climb up with Apple. So Apple's right at the point, the indicators, this is coming down. So I'd like to see that turn up a little bit. It's underperforming its peer group, which is interesting, but it's starting to come back up again. Great accumulation distribution. So Apple, I think, might be a buy right here, or if you wanted to see what the rest of the market does, wait and see if it comes back to the 21 again.
Next up, Tesla.
Tesla. All right. Again, Tesla had a big sell-off right through here, but it was a good time to probably get in. So in Tesla, if you look at the PPO up here, it crossed from the top side and Tesla started to sell off. The RSI came down and it was underperforming the S&P. So this period right here was not a time to be buying Tesla. In fact, if I look at the Elder Impulse, look at the blue and green ones, right? So you want to see these cross and you want to see it above the 200-day. But right now, Tesla actually looks like, I think Tesla has earnings coming up soon.
Wednesday, I think. Yeah.
Yeah. Tesla is one that often will have buyers into earnings and sell off right after earnings. So I'd be wary of that. But since it's going into earnings, let's look at relative strength. And its peers, it's actually doing pretty well against its peers right there. And its industry group is outperforming its sector. So Tesla actually looks pretty good. We'll see. It probably is going to go higher before earnings. I never like to hold through earnings. It's a dicey situation, but never know.
Intel.
Yeah, this is one that is kind of stymied me because the rest of the semiconductor market has been doing really well. Intel looked like it was trying to come back, but then started selling off again. And it's right at its 21-day. So it's right at that reversion to the mean. From the way it looks to me, the PPO is dropping. It looks like it might be selling. It might going to have a sell-off along with the rest of the semiconductors if they all start falling next week. Next week is options expiration week. I've talked about this in my newsletter and gave ample examples of why you have to be careful. So options expiration next week, usually it's opposite week. So if the market or stocks have been going up, then they usually will go down on options day and even the week after. So Intel right now, I would not be a buyer of. I would wait on this one. I wait till the 50-day moving average, which is at 31.72 right now. And it's significantly underperforming its peer group, which is not good.
KLA, it's KLAC.
Oh, you know what? Interesting that this one should pop up. Let me show this one in VectorVest. Because this is one of the ones that was originally on my best of the best chart list for fundamentals. But it's one that I deleted from the list when I went through manually one by one to look at earnings. Look at the earnings chart for KLAC.
Ooh, that's the wrong direction.
Yeah, it's the wrong way. And even earnings growth right there is the wrong way. So personally, I would stay away from KLAC. That doesn't mean it can't go up. You know, stocks can do anything. It's hitting right up against a resistance line right here. In fact, it looked like it hit it and then got rejected. So I think I would wait, especially with the market about to do what it's going to do. If you're already in it, I would probably have a stop down here at this level. Let me see if I can draw this in. I'd probably put a stop somewhere in this level down here.
Yeah, stops
So,
are important.
Around 450. And then I would wait on this. I would wait to see what the market does. I would wait to see what happens next week or two with options expiration. I would, you know, protect myself with a stop right down here around 450. And then if it doesn't get taken out, then and the market starts to reverse, then it could take off. But I wouldn't buy any more at this point.
Yeah. All right. Terex, TEX.
Oh, that looks nice. Nice upward trend. It's above all its moving averages. It sold off a little Friday, but like most everything else did. Accumulation distribution looks great. Versus the S&P looks great. Versus its peers looks great. This one looks pretty good. Again, if the market doesn't cooperate, hopefully you learned something in my, this should be the first thing everybody does now. You can identify a support level right there. So that's what I would be looking at, $50. I would probably put a stop somewhere under it.
$60.
I'm sorry, $60. I would probably put a stop somewhere under it, or if you want to, you know, be conservative, probably around the 21-day moving average, which is 58.75, 59, somewhere around there. But there's the support level right there. So it needs to hold, and you can see it hit that, came down and formed what's called a cup and handle.
Mm-hmm.
And usually that's very bullish. This is the kind of thing that IBD likes to see. By the way, I'm going to add IBD to my list of scans that I do every week for my best of the best portfolio. So I'll include the IBD 50 in there too. But this is what they like to look at. They like to see the stocks that go down, make a nice rounded bottom, come up. Remember what I said, all these people here just want it to get back to break even so they can get out. So it gets back to break even, they start selling, but the stock is strong enough that it doesn't push it all the way back down. And all these sellers finish their selling and new buyers step back in. And that's what makes the handle to the cup. So if it breaks through, which it has, breaks through that resistance level, then that's very bullish. And the way to determine the target for that is that 60 level and the bottom of the cup, which is around 44. So the difference is 10, 16. So a potential target for that is $76 for this particular one. That's how you calculate. And this takes time to recognize patterns like this, but patterns also allow you to identify what the target should be. So that one actually looks pretty good.
Next up, Disney.
Ooh, Disney's been looking bad for a long time. Disney sold off on Friday, and Disney looks awful. Look at that, Disney versus the S&P, Disney versus its peers. All of these momentum indicators are near the bottom. It's below zero. If I look at a long-term weekly chart, you can just see ever since back here in 2021, it's just been doing nothing but selling off. Below all of its moving averages, below the 200-day. I mean, Disney is one that I would stay away unless you're really aggressive and you believe that this support line down here, I'll be right about there, which is just about where it's at. If you believe that that support line is going to hold and really be the bottom, of course, you should get confirmation for that to happen. And confirmation would be if it starts to move up and it gets above the 21 and 50-day moving averages, and it has positive volume. So you can see here the volume here on the down days, the red bars, much bigger than the solid bars, the gray bars. I would like to see this get it back above the 21-day, which is reversion to the mean, and do it with big volume. The only positive I can see about this is that it's hanging out on the support line. And even though it had big volume, it really didn't move the stock that much for the week. Oops. So, you know, for the week, this is the support line down here. Looks like it wants to come back to it again. So, you know, had big volume to the downside, but I think Disney is just basically going to be bouncing along the bottom until Bob Iger does something dramatic.
Well, I think he's talking about selling off a lot of TV assets. That might do it.
Right. If he actually does that, that might do it. So
Yeah,
that's what I would, that's what, you know, for Disney, if I was in it, it would be painful if I was in it from way back there.
Yeah,
That's the thing, you know, that's the thing with setting stops.
Yeah.
Right. You can see the moving average lines crossed right here. So that was the first signal to get out. The PPO actually crossed way back here. So that was the first signal to get out. The moving average line crosses, signal number 2. It went to its 200 but couldn't hold it. So there's number 3 right down here at about 135. But if you didn't get out and you're still in holding this, it's probably too late to sell at this point. I'd be watching this support line down here and hope that Iger can do something and it starts to move back up again.
AMD was next, or did we do that one earlier in the show?
Nope, AMD.
Okay.
Yeah, this one's interesting. I was watching this. This AMD is actually one that I'm in from 85 back here. This is one of my scans that looks for downtrend reversals. So it looks for downtrending stocks that have reversed. So right in here is where I bought it. And it had a nice run and it came back, hit the 50-day moving average. And I'm very concerned. I was very hopeful on Friday when it had that big run higher, but I was very concerned. We look at a 1-hour chart. So here's Friday in the morning, went all the way up and then did nothing but selling all the way back. The only thing, and so I've moved my stop up, and because of everything else that I talked about for next week, options expiration and technology needs to take a break. We're actually at right now, Tuesday, I think, is the actual peak from Stock Traders Almanac. Tuesday is the peak for the NASDAQ for its best 8 months. So if options expiration sends things down, if the market goes into summer doldrums, if we really are at the peak, all the things that I put in my newsletter that basically said, be careful, looks like we're going to head lower or at least go sideways for a couple of months maybe, then I'm probably going to be out of this. I think my stop right now is down here around 114, right at the 50-day moving average. The only thing that makes me a little bit hopeful is what happened at the very end of the day, the last 30 minutes. You can see the momentum indicator started to move up here. So this is, again, for day traders, the kind of thing you look for on a 15-minute chart. You look for the RSI to be down here and to start moving up. You look for the PPO to start moving up. You want volume as this bounces off of a support level. So that's the only thing that looked hopeful to me about AMD. But if it can't hold right about here, you can see it was resistance here. Resistance eventually becomes support. So now it's testing to really see if that is support. If it can't hold that level, then I will be out of this one. And I will just wait for the summer. I probably won't do much trading this summer.
Mm-hmm.
But AMD is a good company. It's a good stock. Mm-hmm. It's a good one to own. And for those who are in it long term, I would say stay in it, because I think AI is going to push all of these things up eventually. But, you know, I made nice money from 85 to 115. So I want to protect my profits.
Next up, Redfin, RFIN.
Or RFIN.
Correct.
No, that's not.
No,
It's
Redfin.
RED. It's not
Sorry.
RFIN.
Oh, sorry.
There,
Oh,
there it is.
RDFN.
RDFN. That's what it is.
My scribble was wrong. Sorry.
RDFN. Okay, Redfin, it's having a nice run. It's pretty far away from its moving averages, so it needs to revert to the mean. Had a great couple of days with huge volume, so that's very positive. The RSI is overbought, so a little caution there, but you know, these momentum indicators can stay overbought for quite a while, so you can't automatically say, well, just because it's above 70, I need to sell, because those can actually stay overbought for quite a while. So the thing I would do on this one is, and it's doing great against its peer group and against the S&P. So this is a great example where you just revert to the basics and you start drawing in support lines. So there's a support line there. There's one right there. So I wanted to hold 14. I actually like this one. This is one that I might watch. If it pulls back to the 21 day, then I might actually step in and buy it down there at the 21. By the way, this is a little, I don't know if anybody has this on their list, but this is also one that this is completely against all of the other rules that I showed you, other than my risk calculator. This is one based strictly on social. This is a social trade. Mm-hmm. So when everyone started talking about the Barbie movie, mm-hmm, about a month ago or so, I bought Mattel down here.
Ah, smart.
See that hammer right there?
Yeah. Yeah.
That hammer at the bottom of a trend, and I actually have a scan for hammers that's on my website. I bought it right after that hammer right here. And I'm actually still holding it because I want to see what happens when the movie comes out, but I've moved my stop up because I don't want to give back these gains. Yeah. By the way, one rule that I use for stops, just for everybody can pick stocks in different ways. And the stops that I showed you with my risk calculator is a good way. So the entry point, when you first get in, you want to protect your downside because you want small losses. But once it starts to take off, my rule is if it gets to 5% or more, I move my stop up to break even so that I can't lose money. Once it gets to 10% or more, I move my stop up to half of my buy price. So I will protect half of my profits. And if the stock keeps going higher, then I just keep moving the stop up to half of whatever the high is versus my entry point. So that's just a little rule that I use. And different people can do it different ways. But if we draw a support line in here, and hopefully you guys can start recognizing these now after that little exercise that we did. So there's a resistance. So it broke through that. So that, if it does come back, that's what it probably will come back to. Actually, if it comes back to the 21 day before the movie, I think the movie comes out in 2 weeks, 21st. Then I think after the movie, it's going to probably take off some more. And this is a great example of buy the rumor, sell the news. Hmm. So be in it until they report earnings.
There you go. Somebody asked for what the discount is again. It's the number 42. Number 42 is the promo code. The number 42. Code, but yeah, 42.
And ask people to tell you if it's working or not.
Yeah, so far I don't have good news for you. So far,
not working. All right.
We'll give it a shot. Tell us if it's working.
Yeah, I think I need to fix. I'm going to fix something in there, and everybody try it later and send me an email at breakpointtrading@gmail.com.
Yeah. Well, let's keep going. We promised them an hour of stocks.
Go ahead.
Next was PayPal.
PayPal is trying to recover. Hasn't broken above its 200-day moving average yet. It is just beginning to outperform its peer and the S&P, so that's positive. So it's trying to get up there. You can see a pretty clear resistance line right about here. So I think that's the level it needs to break out of, 77.50 basically. That will put it above the 200-day. If it breaks above that level right there, I expect to be a lot of resistance when it gets there. Just remember what I said, all these people back here that bought, they're just waiting to break even. So I expect when it gets back to 77.50, it's probably going to come down and it might form a little handle on this cup. So if you're not in it and watching it, you know, you could be proactive and buy now and just put a tight stop on it. I'd put a stop around the 21-day, probably 67.50, and then wait and see if it forms a little handle. And if it breaks out of 77.50, then the target would be, this is basically 67, about $17. So 94 would be the target on it.
All right. Next up, NVIDIA.
NVIDIA, everybody's favorite stock. NVIDIA, look at that chart. Great example. Revert to the mean, 21-day, 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 zoom, earnings. Took off for earnings. Now, in this one, I think I mentioned this on your call. I bought a little bit of NVIDIA, an entry buy at 305 just before earnings, literally 5 minutes before the end of the day, before earnings. And then it gapped up and it's never looked back. So
you still have your one position.
I still have that one position. I have an order in for another one at 400. And let me show you why. But that's even above the 21-day now. So somewhere right around 400 is right there. Right there, you can see, you know, this was a resistance. It broke through, then it became support, went up. So this is a support level right here. But I don't know if it's going to ever come back to that again. But if the market doesn't cooperate, and if with options expiration next week and the way all these semiconductor stocks look, you know, this is a shooting star as well, just like AMD had. And all of the semiconductors look like this, by the way. They all had great moves in the morning and then gave everything back in the afternoon. So if that continues and it comes back down to the 21-day, then I might consider doing a second buy down there.
There you go. Next up, PCG. I think that's utility, I think.
Yeah, utility.
Yeah, PG.
Actually looks pretty good for a utility. It's trending up. I mean, utilities usually pay great dividends. So if you want to be in a dividend stock, you want something that's not volatile, right? You want something that's sort of just like chugs along, moves up a little bit, and just make money off the dividends. And that's pretty much looks like what this is doing. Now, on stocks like this, I like to look at a longer term chart. So it's above all of its moving averages. The PPO is about to turn up. It's definitely outperforming its peers. That's good. It's hanging in there with the S&P. Utilities, if there is a downturn over the summer, utilities is in the defensive group. So again, on my website, if you go to the utilities sector and look at the chart for that, you probably will see that it's starting to move up a little bit. So this is one, if I was in it, I'd hold it, just hang in there.
Okay, Berkshire Hathaway.
If not, actually, I'm hoping that you guys will start picking out these support and resistance from this. You see resistance there and now support. So 1650, you know, is right below the 21-day. So if I was in it, I'd probably put a stop right, or probably at the 50-day moving average, which is at 1614. What's the next one?
Berkshire Hathaway. I don't know the symbol, sorry.
BRK A and B, but Let's look at B. Good old Warren Buffett. Now, with this kind of stock, I would use my 200-day. This is a 2-year view. So I'm not sure if you would ever sell Berkshire. If you're in Berkshire, you probably just want to hold it. But if you're looking to enter Berkshire, I mean, this would have been the time to do it down here. And remember, this is a 2-year chart, and it is a daily chart. So you can see down here is, if you had been watching it down here and took off and hit the 200 and got rejected, came back down and then hit this twice more, so 3 times it's hit support, and then started to take off again, then probably one of these green bars right here would have been a good time to get in, at least with a first position. And then a second position will be when it breaks the 200-day. Right now, it's trending higher, and it's a little above its moving averages. So you can see how much space it has right here. I don't think it's coming back down to the 200 anytime soon, unless the whole market falls apart. But it could retrace back down to the 50, which would put, there's a support line right there. So somewhere right around 333, 332, something like that. But overall, this should continue higher. Here's the high back here. So you gotta be aware of that, because that's when all these people want to get back out, right? But that's up around 360. So if you hold it to 360 and then wait and see what happens, if it breaks through 360, then man, it's going to be a monster. Yep. 360 to 260 roughly. It's about 100 points. So you go to 460.
Palantir.
Palantir. I use this one as my example. Yeah, I got it. I use this as my example with the risk calculator. So Palantir is a volatile stock. It has a very rabid following, let's say.
Yes.
Its PPO looked like it was trying to break out, but you can see the light gray line, the stochastics behind it. So the PPO will give you the momentum, and the stochastics will tell you oversold or overbought. So while the momentum is trying to move higher, it's also in overbought territory. But now notice back here, like I said before, it doesn't automatically mean to sell just because it's up there. This is a great example right here where, being overbought for the RSI can stay that way for quite a long time. All through this run, it stayed that way. So once that happens, then you no longer really look at the momentum indicators anymore. You start looking at moving averages, which actually shows you what the trend looks like. So in this case, it's actually stayed above its 8-day, which is very, very strong. And then it came back to the 21, the reversion to the mean, and then started up and came back and touched it again. It looks to me like it wants to come back and touch that 21 again. It's outperforming its peers and the S&P. But there is major resistance right there. So again, this one's going to depend on what the rest of the market does. The accumulation distribution is rolling over too. So this rally right here might be running out of steam. So in Palantir, that's one that I would watch. If it could break through this, it looks like about 1650 with volume, then that would be a good entry point. Otherwise, I would wait. I would watch the market, see what the market's going to do. Wait for it to come back to the 21-day and see if it could be a good entry right there.
Okay. CCL, which I think is Carnival Cruise Line.
It is. CCL is one of the ones on my best of the best chart list. So this one, all the cruise lines have sold off the last couple of weeks. The PPO is rolling over. The stochastics, which has been overbought, is rolling over. The RSI, which has been overbought, is rolling over. Accumulation distribution is starting to come down. It's outperforming its peers and outperforming the S&P. I think it looks like it needs a rest, frankly. I don't know how far that means it will go, but Here is a support line right there. So we'll need to see if it can hold that at 16. So if it comes down to 16 and holds it, then, and what I mean by that is it starts giving you some solid white candles like this. If it gives you one of those with big volume, then it's time to get back in. In fact, if we look at CCL, if we look at it using the impulse chart, you can see it's got red candles right now, red bars rather. So you do not want to buy on a red bar. You do not want to buy on a blue bar. You can buy on a green bar, but it's best to buy it right after a red or a blue. So right now it's got a red one and it's right at the 21 day. So we have to see if that 21 is going to hold. Then we have to see if 16 is going to hold, which is the next support level. If those don't hold, then the 50, and it may go all the way back down here to this major one down here at 1250. But that doesn't mean it will.
Right.
So if the rest of the market doesn't cooperate, then CCL, it might be, you know, selling on. I don't know when they report. They might be reporting sometime soon. A lot of earnings coming up here soon. This is one that I probably would not buy before earnings. It is outperforming its peer group, but it's starting to come down. So it's not one that I would buy before earnings. I would wait for the earnings to see what the reaction is. Buy it then.
Next up, Carvana, CVNA.
So Carvana is interesting. One thing that Tom Bowley does on his site, Earnings Beats, is he puts together a list of short candidates, short covering candidates. And it's the stocks that have the most outstanding shorts. And he ranks them by the one with the most. So as an example, when GameStop last year, GameStop was on his list. It showed the short percent was 120%. There were more shorts than there were the stock available.
Yeah, I saw that.
That was crazy. But he put together a list like that. Carvana is on that list. Short candidate list. So the important thing to understand about short candidates, and I know there's a lot of folks on the internet out there that say, hey, we tell you short candidates and these things they're double bagger or 10 times or whatever because they're short squeeze candidate. Well, that might be true, but remember that all these people back here were short. These are all shorts. They're not feeling any pain. They have no reason to cover their shorts. Even if it goes up to here, they have no reason to cover because a lot of them are short from back here, right? So it doesn't really become a short squeeze until, number one, it goes above the point where the shorts first shorted, meaning that's where they're starting to feel the pain. And it does it on volume, like this day right here. So you theoretically, I haven't done this, but you theoretically could write a scan that says, against this whole list of short candidates, tell me when any of them has volume that's 5 times normal and has increased by 5% from the open to the close.
Oh, there you go.
All right. So this one now is a short squeeze because it satisfied all that criteria. Now it's sold back off right here, but it's continuing up, and the short squeeze might even be continuing because some of these shorts probably got back in thinking, well, that was it. That short squeeze is over. I don't know what the percentage, it's still on the list, I think, but I don't know what the percentage is. So this one is one of those momentum trades where as a short squeeze, and actually it looks pretty good just from my peer group perspective. So it's outperforming its peer group and the S&P, which is very positive. So this is a good one to get in. I think it might be a little bit late. It's pretty far away from its 21-day moving average. And if I draw in the support line for this, I put it right about here. So probably right around 27.50 is where I'd want to put a stop, but it's pretty far above that right now. And it really hasn't given any new support levels yet since then. So the only ones to go by is the moving averages or the previous day's low. So previous day's low was 35. You could buy it here and put a stop at 35. And then if it does keep taking off, keep moving your stop up to the previous day's low. But that's a very aggressive trade. That's not a long-term trade at all.
Mm-hmm. Next up, I think, is Newmont, NEM. I think. Yep.
Gold stock.
Yep.
Gold has been trading sideways. Gold might be getting ready to actually take off. Let me look at gold. So here's gold. Gold and Newmont are probably going to be similar. In fact, one thing you can do is, I think it's a gallery view. I can do Newmont and GLD together. So that shows me both. This is in stock charts, by the way. That shows me both of these side by side, and we can see how correlated they are.
Yeah.
So this one up here is an intraday view. So you can see gold. They look almost the same. Here's a daily view. Newmont gold is actually outperforming Newmont, but Newmont might be trying to catch up. Here's a weekly view. Again, Newmont is underperforming gold. So Newmont actually might be a good spot here soon if gold really starts to take off. So that's a big if. We don't know if that's going to happen or not. One thing to look at is gold versus US dollar. So a little off because it doesn't have an intraday view. But if we look at the weekly view, you can see gold on the right over here and the dollar on the left. The dollar is dropping off a cliff.
Mm-hmm.
By the way, one thing on my site that I forgot to show is on the homepage, there's these charts up here. This is available even if you don't register. You can get these charts. This has an S&P chart. Shows it's a daily chart of the S&P, but it also has a dollar. And there's the US dollar. You can see it's dropping off. It's trying to make a comeback right there. It also has Bitcoin on here. So if you're a Bitcoin trader, Bitcoin is just hanging out right at its resistance, which has been doing for over a month now. So it's trying to figure out which way it wants to go right now. Okay, so Newmont, I would say, depends on gold.
Okay.
It's right at its 200-day moving average, which is good, and it's outperforming its peers, but it's kind of underperforming the S&P. It's really going to be more related to gold, though, than the S&P.
Okay. Enphase, ENPH.
Yes, Enphase. Enphase was a darling for a while. We look at a weekly chart. Enphase had a nice run up in 2021 and even in 22. And then all of a sudden, all of the alternate fuel stocks started to drop off. And right now it doesn't look good. It's underperforming its peers and the S&P. It's below all its moving averages. It looks like it might be trying to make a recovery. If we go back to the daily, so right here, it's just gotten back above its 8, 21, and 50, but it's still not above the 200. Barely. It's basically treading water with its peers and underperforming the S&P. I wouldn't be ready to get into ENPH right now. But if that whole group starts to outperform, and there is an industry group on my website for renewable fuels, renewable energy, you can actually watch that and see how it does. Actually, I can go there right now. Right here, renewable energy. So that industry group, this is a weekly chart. So it's come back up and it's hitting, its resistance area, it's kind of going sideways right through here. So it has not made a convincing move yet, but it might be, and it might still be a while. I mean, this might take through the summer doldrums before this starts to take off. This is the industry group itself, not ENPH specifically. But it's always something that you should look at, especially on something like this where you're not sure if the chart really isn't jumping out at you to tell you something. Then look at the industry group and look at the long-term chart, see what it says. But you know, right now it's starting to roll over. I'm not a big fan of this group right now. Look at the big gap too. Remember that gap that I talked about before?
Yep.
So it's got a big gap right in here that usually will get filled. So that's a good sign. If it does start to take back off, it's probably going to go up and go up to 220, which is right near the 200 will probably be down to that gap by that time. So that's the point where either it gets rejected or if it goes through it, then it will take off. But I wouldn't be a fan of this one right now.
Next up, SoFi, SOFI.
Oops. Oh, that looks pretty nice. This is one where it's acting very well. It had a great run up, came back down. You see how how volume has dropped off on the pullback. It pulled back to the 21 day. This is a textbook example of technical analysis right here. Had a great run up. Would have been nice to grab it right here. By the way, this is just an aside, but this dotted green line right here, it's called a chandelier exit. I'm not going to get into a lot of detail on this, but this is basically using the ATR, the average true range. It uses 3 times the average true range to set a stop level. One of the ways that I use it is I look for stocks that are coming from below that to above it. So this little candle right here on SoFi would have triggered my scan. That scan is on the website too, by the way. So this candle would have triggered my scan, and I probably would have got in here. And then it got up here and gave an indecision candle. See that little spinning top at the top? So it had just as many buyers as it had sellers, and it ended right in the middle. So that's an indication that probably this run is going to take a pause, which it did. Came back to the 21 day, tried to make a run again. You can see that chandelier exit is right there. Came back to the 21 day and bounced pretty nicely with some volume. So this one actually looks pretty good. Look at it's outperforming its peers, outperforming the S&P. And this one I'd probably put a resistance line right about there. So 950, if it can get through 950, it might start to trend higher again. I actually like this one. This is what I'm going to keep a watch on.
Next up, I think it's AT&T, letter T.
Well, that doesn't look good, does it?
No, wow, no, it doesn't look good.
Outperforming its peers, though. Isn't that interesting? Underperforming the S&P, but outperforming its peers. So, yeah, it doesn't look good. It's below all its moving average, below the 200 day. Look at the weekly, longer term. It's just a mess. That's a mess. Frankly, I wouldn't know what to do with this chart. This would be one that would be a trader's chart. You know, one that I might, you know, there's support down here, right about where it's at 14. So it might make sense to be a buyer down here at 14. But actually, let me do this. This just looks like a sideways channel right now. It's got one right there. It's got one right there. And it's probably just going to bounce back and forth. So if you wanted to be a trader, you could buy it at 14 and then sell it at 20. Buy it at 14, sell it at 20. Buy it at 14, sell it at 20. Just keep doing that. It has a good dividend though. So for the dividend, if you're buying it for the dividend, this actually isn't too bad. because the stock really isn't doing anything, but you're still making money on the dividend.
Yeah, 7% dividend if that's
Right.
up there.
Right. So for a dividend stock, it's probably a good one.
Next up is Boeing. I think it's BA.
BA has also got a lot of volatility back and forth. So long-term chart, it's above the 200-day, which is a good thing. It's actually staying above the 200. It looks like it made it up to that resistance. It's barely outperforming its peers and the S&P. So it's just basically going along for the ride. But where it's at right now, which is 220, that was resistance back here, resistance again here. And it's been hitting this resistance area for a while now. I put it right about there even. So it's just hanging out right at that resistance level. So it's waiting for something to happen. If it can break through that, then I think it's probably going to make it back to the high up here at 260 or so. But there's nothing that tells me it's ready to do that.
Right. So
this is one that, if you know the fundamentals, the company, that they've got some things coming, might be one to be in. But technically, it's not one that I probably would want to be in right now. But if you wanted to be a long-term holder and we're looking for an entry point, then I probably would say around the 50-day moving average, 207 or just below that, 205 would probably be a good entry point.
All right.
And then just ride it out.
Next up, SFM, Sprouts Farmers Market.
All right. This recently has had a nice move, pulled back on Friday. You notice on Friday, everything's pulling back. Seems to be a trend there. Outperforming its industry group, it's coming down a little bit, barely outperforming the S&P. Accumulation distribution looks pretty good. It's being accumulated. So in general, it looks all right. If I look at a long-term chart, if I want to see where the resistance, it looks like it's actually above kind of its resistance levels. So it's either going to make a run for it or it's going to get rejected here. So this is sort of a binary situation. If it does pull back along with the market and everything else, probably somewhere around the 21 or the 50-day moving average might be a good place to look at it. It's outperforming its industry and the S&P, so fundamentally it's probably pretty good stock. Let me actually look at it over here in VectorVest. SFM. Yep, look at earnings. Earnings look good. Growth rate of earnings looks good. So, for a fundamentally, it's a good stock. This one might have even made my best of the best stock list. You see, yeah, 120 and growth. Now, for the growth isn't enough. I want growth of above 18% per year. This is 14% per year, but that's, it's decent growth.
Mm-hmm.
So, for a fundamental standpoint, it looks pretty good. From a technical standpoint, I probably would, again, wait to see what the market's going to do. And then look at the 21 or 50-day if you're looking for an entry point, somewhere around there. Don't just blindly enter at that. See what it does when it hits those. So you want to see it to come down and then start to go back up again and watch the volume. So this whole run right here, this whole run is made in the last month, is done it on low volume. So that says that it might be running out of steam, and it might, it might be time to pull back a little bit. So it's a good stock. Fundamentally, it looks pretty good. From a trader's or an entry level standpoint, it probably would be a good entry if the rest of the market cooperates. So, I think we're going to have some sideways movement over the rest of the summer, and it might get started next week. So we'll see what happens.
All right. Next up is STEM, STEM.
This is one that we talked about on your channel. Yep. All right. STEM is interesting because they have a technology for chargers.
Yep.
for EVs, which I think eventually is going to be pretty good. And from a technical standpoint, it's trying to make a run here. It's above its moving averages, still below the 200-day. It doesn't even show the industry group. So, you know, it's not probably not widely traded enough. Let me see what the volume is. Well, yeah, 5 million shares volume, average 5.6 million shares. So it's got plenty of liquidity. So it looks to me like this is one that wants to just slowly chug higher. If I was in it, I'd probably stay in it. If I wanted an entry point, I'd probably be looking at somewhere between the 21 and the 50, just like it did right here. Somewhere in this range, around $6, $5.50 to $6. But it looks like one that probably wants to go higher. So for the long-term chart. Well, it's had just basically ever since way back here, in 21, it just basically has trended down since then. So this is one that, this is a risky play, but it's one that if you wanted to put a little bit of money into it, it might pay off, because I think if something happens in that space, or they get some kind of contract with Tesla or somebody else like that, this is the kind of stock that would just shoot higher very quickly. But it could also just as easily do nothing, just could go sideways down here. So that's the thing that you have to weigh. That's the balancing act that you have to make. The one good thing is that it's had huge volume on these up days over the last month or so. So this, to me, this volume right here, with not a lot of movement in the stock, says to me that somebody knows something is going on with this company. So it looks like accumulation to me. Accumulation distribution is just kind of sideways. But that volume is pretty interesting. These are the daily bars. So you can see the volume is much bigger than the selling. The up days are bigger than the down days.
All right.
So this is an interesting one. It's a speculative play, so I wouldn't, I'd bet a small part of my portfolio. If you were using the risk calculator for this, I probably would maybe use 5% of my portfolio instead of 10, and just buy fewer shares. But
Biogen. Oh, sorry.
Biogen, BIIB. It doesn't look like it's having a happy time. It's below everything, below all moving averages, including the 200-day. Underperforming everything. Accumulation distribution is down. Huge sell-off right here. I think that might have been earnings right there or something. Some announcement happened right there. So Biogen is not looking good. If you were already in it and did not use stops to get out, I mean, it potentially, I hate to say this, but it potentially could come down to this major support level here, $200, and there's a minor support level here as well, at about 250 or so. So I think probably, and there's the 200-week moving average, this gray line here. This is a weekly chart. So this gray line is the 200-week moving average, which is at let's call it 280. So it probably will come down to that 280 point, somewhere right around here, and then try to make a recovery and come back up. And then what I would do if I was in this, if that did happen, if it came down to the 200, this area, and bounces started to go back up, then I would put my stop in right there, just below 280, maybe 275. Wait, this is 275 here. It's the 144 moving average, 264. Sorry, that's 264 where that is. Okay. So probably I'd put a stop if it came down that had bounced, started back up again. Put a stop in. Yeah, I mean, you could put a stop in there right now at 260. That's both the support level and the 200. Gee, that's a 144-day moving average.
Very cool.
So you can put a stop in there. If it does bounce, starts to go back up, then just move your stop up with it. But this does not look like a very healthy stock right now.
All right. We could probably got time for two more. We'll do Arista Networks.
What's the symbol?
ANET.
Oh, yeah. Oh, yes. This is one that I think is on ANET, was like in VectorVest's top 20 or something for a while. I don't know where it is now. But I'm gonna look at it here on VectorVest. Oh, they see the earnings are not good, so I probably wouldn't be in this one, and the growth is going down.
I think that you're looking at KLA. You're looking at the wrong company.
Oh, I'm sorry, you're right. I've got three of them up there. There's Arista. Oh yeah, earnings going up. Relative value is 153. That's really good. Growth is 29. That's really good. So this is one that is in my best of the best chart list right now. And you can see right away from here, you can see that it's right at this resistance level and may come down to the support level down here, depending what the rest of the market does. But I'd be watching the 21-day moving average if you're looking for an entry point. Get into it right there. So company-wise, it looks like a really good company to own. So then it's just a matter of figuring out where your entry is. Again, don't just buy at any old place. So there's a pretty significant resistance level right there at 170. Right there, 170. So you see it went right up and hit it and came back down. So you want to see it get through that 170 level. Support would be down here at 21 first, and then the 50-day moving average around 155. But it's a good company. So this is the kind, using the best of the best chart list, this is the kind of thing where you can set your stops a little bit lower because the fundamentals are good for the company. And you can probably ride it out a little bit longer for that reason. But it's, you still want to figure out the right entry. Don't just buy it at any particular price. You know, it came right up to the high right here and started to sell off.
And we'll do our final one. We'll make it Snap, S-N-A-P, Snap.
Snap had a nice run. You were in this one, weren't you, for a while?
I was, yeah.
Snap RSI is overbought, but again, it can stay overbought. Everything's overbought up here. The stochastics, but the PPO is still moving higher. So this is one that and it's beating its industry group, its peers, and it's beating the S&P. So this is a good one. It's also in the internet space, which is one of the top spaces right now. It's also where Meta is. There's a support level right there, just above 12. 21-day moving average is 1183, so right about 12. So I would probably put a stop in right below 12, you know, 1195 or something. And if it gets taken out, then wait for another entry, get back in. But this is one that probably might continue higher. Let's look at a longer term chart on this. See what it looks like. By the way, the reason I keep re-entering it is because when I put lines on it, if I want to exit, then it asks me if I want to save it.
Yeah.
I'm not going to save these. Yeah, so here's Snap. You know, as good as that daily chart look, let's go back and forth. Here's the daily chart. Looks pretty good. It's a whole different perspective when you look at the weekly chart.
Yeah.
This is a good reason why you should look at both of them. That's why I have both of those buttons right at the top of my list, the daily and the weekly side by side. So on this one, the weekly is right about, probably right there. It's right about 15. And that goes back a long way. That goes all the way back to, you know, a year ago. at 15. So it's going to have a hard time breaking through that. But if it does, it's above its moving averages, which is good. It's still below the 200 up here. But if it does break through that 15 level, then it could have a nice run.
Yep.
But I'd be very wary of the 15 level. You know, it might have a lot of resistance and trade sideways or up and down for a while right there. Anyway, all these are just my opinion.
Yep.
They're not recommendations
No.
by any means.
You know what, Dan,
So-
do me a favor, show your email one more time so that way people can reach out to you via email if they would like.
Email is breakpointtrading@gmail.com. I am going to send me a note if you can't get in. Send me a note to that, breakpointtrading@gmail.com, if you can't get in with the code. If you've already bought it at the $99 anyway, then we will figure out a way to refund you. If you have not bought it, give me a chance to see if I can fix something, which I'm going to do here in just the next 30 minutes and see if that will work. And then if it still doesn't work, just, you know, if you can't get in and you want the promo, send me a note and Mike and I will figure out a way to make it right for you.
Yeah.
So I know
So
you've been
folks,
a hard stop at 11. So thanks for putting this together.
yeah, you got it, folks. So at the end of the day, Dan Bird has helped me become a better trader. I'm very thankful he was able to give us 3 hours and give you a rush through. As promised and as advertised, it is enough information that all of you will have to watch this again. That much I know. My team will download the video, chop it up. It probably will take 2 weeks, but you will have it. You will also have this PowerPoint. And again, if you like his yearly subscription, let me pay for almost half of it. If you sign up, I will somehow cover $47 if you paid for this event. It's only good for the people that paid for this event. I'm not paying for everybody, just the 150 or so of you that signed up. If you want it, I'm going to cover half your cost for the first year. Dan, everybody else, thank you very much.
And the promo code still should be 42, the number 42. If I get that fixed, it would be the same promo code if it works. We'll see. But if not, just send me, we'll make sure you get covered because I'll know who has signed up for the annual and Mike knows who has signed on to this session. So we'll compare those lists and make sure you're covered.
All right. Thanks, everybody. Take care of yourself. Thanks, Dan.
Thanks,
Take care.
everyone. Take care.
Bye.